Good evening, Deepak.
गुड इवनिंग नीलेश जी।
So, how are you?
मैं बढ़िया हूँ जी।
Okay.
नीलेश जी बिलीमोरिया जी कब आ रहे हैं? हाँ रवि जी,
कैसे हैं दीपक जी?
पार्टिसिपेशन काफी कम होने वाली है।
हाँ,
मतलब पार्टिसिपेशन कम है अभी।
देखते हैं अगले 10 मिनट में शायद ज्वाइनिंग हो जाए।
Hi, good evening.
गुड इवनिंग सर, हाउ आर यू?
Fine, fine, yes.
You seem pretty tired, sir. Doing late.
Yeah, no, not late work, exhausted. Just थोड़ा hectic था.
अभी
अच्छा,
मैंने कहा अभी तो दिवाली नहीं आई।
हाँ, अभी से हालत खराब है.
गुड इवनिंग मानस।
माना जी अपने फोन पे बिजी होंगे।
अच्छा,
देखो बड़े आदमी हैं, क्लाइंट हमेशा बिजी
Speak
रहते हैं।
to Zubin sir. I'll just call
हाँ,
him.
रवि बिलीमोरिया जी कब आ रहे हैं? आपकी आवाज नहीं आ रही। एक सेकंड होल्ड करना जी। चलो
नीलेश जी उनको ही फोन कर रहे हैं।
ओके।
Sir is just logging in. Hello.
हाँ जी।
Very good evening to everybody.
Good evening, sir.
Very sorry, there was some slight connectivity problem.
Oh, okay. It's resolved, I hope. But
Good evening, sir.
Good evening. Can I just test the screen share?
sure, sir. Deepak ji, you have enabled, no, to sir.
For every participant, sir.
Fine.
Panelists.
Yes, it is visible.
Visible?
Yes, sir.
Yes, sir.
Visible now also? Yes.
Yes, sir. You can go to that screen mode. So then it would be.
Is it okay?
Yes, sir.
Clear?
It is clear, sir. You can start the slideshow, sir.
Yeah, its slideshow is already on.
Okay.
Is it okay? Is it? Or,
No, it is in that standard format. So
You need to press F5.
sorry, SWOT 5?
F5, function key F5.
Okay. I'll do that.
Yeah.
Okay.
yes, sir.
I think again you have to change the mode.
One
And
minute.
let me guide you. Just a sec. Can you give me control? Just a sec. Can you give me control?
Yes.
Okay. So
Because when I'm going on to this, yes.
just a sec. It should not like this.
Hello.
Deepak ji, it's 4:55. Shall we start?
Just a sec. Just a sec. Just a sec.
Yeah.
Check कर लूँ जरा.
Is it?
Can you just close this file again and reopen this file again?
Okay, I'll do that.
Just close it down. Yes. Okay, restart the file.
1 minute. I'll have to just. Yeah, I've reopened the file.
Okay, now you share it.
1 minute. Just. Yes. Yeah. I'll do slideshow.
Yeah, please start.
I think it's coming.
Maybe
I think
are you using dual screen?
I'm using dual screen. Yes.
That's why this problem is appearing. Just a sec.
Yeah, I'll just.
Can you press Window and P key, or maybe just
Sorry.
Just a sec. Actually, you are using dual screen mode. That's why I'm not seeing that particular screen.
Okay.
Or do one thing: start this presenter mode. Then in the share screen, select the one which is being shown on another screen. Can you do that?
I'll do that. Yes, I'll do that. 1 minute. Stop share. I'll do it first, right?
I think you should stop first of all dual screen
Yes.
display.
Yes. Then I do share screen.
Right.
Yes.
Start the presentation.
Yes.
And then share the screen.
Just start the presentation and then share the screen.
Yeah, you have to first start the presentation. Only then you share the screen. Because actually dual mode is creating problem here.
The new share, we move resume share. Yes, okay. Or shall I switch off the monitor?
Yes, it will be better that you switch off that extra
I'll just
screen.
switch off the monitor, I think, so that I'll just switch that off.
Or maybe using window P key, you can select this laptop only.
Window P.
Window and P for Patna.
Where is window? Which is
In the bottom row.
window and
P for Patna.
okay.
Select PC screen only.
But I have done window and P. Okay, and then a PC screen only. Okay.
Right.
Yes. Yeah, I have done that.
Okay, now stop the screen sharing
Just stop share. Okay.
and reshare. Start presentation and reshare.
Start the presentation.
You see, for PPT, there will be two screens when you start the screen. One is the actual presentation, and one is which is being displayed, which is the actual presentation which is being displayed on a screen.
So 1 minute. The actual presentation.
Or maybe if you have any desk, you can give me any desk. I can see from here.
No, 1 minute. I think I am getting this.
Okay.
I think this is the screen. I think now I start with share screen.
Right.
1 minute. I'll just.
Or maybe you can do one thing. You can share the presentation with us. We will.
No, it's already there with us. That's not.
Only thing is you will have to just correct the date. I think because earlier date is. 1 minute. Let me just see share screen.
Yeah, better.
Sure.
Now is it coming? I'll do the. Let me just try once more.
Yeah, press F5.
Yeah.
Have you pressed F5?
Yes.
Yeah.
Yes,
it is perfectly now.
Now it is perfectly.
Yeah, it
Right.
is perfect.
It is perfect now. So you can go back to first screen, first slide.
1 minute. I am not able to go back to the. Okay. First slide. Where is?
Just use the cursor keys, sir.
But the first slide is not coming. I'll do F.
Yeah, so this way it should be fine, sir.
I'll do F. This is okay.
No problem. Let's
Yes.
do with this only.
Yes.
No problem.
First slide is not important.
Yes.
Okay, you can start. Sorry.
Sure, sir.
Nilesh, I'm starting.
Sure, Deepak ji.
Okay.
Yeah.
Very good evening to all of you. My name is Deepak Bholusaria and I welcome you all on this long-term session on long-term course on real estate sector. Till now, we have discussed RERA, direct tax provisions, indirect tax provisions. Now it is the time to discuss Ind-AS provisions which are related or which are connected with the real estate sector. We have with us none other than Mr. Zubin Billimoria from Mumbai. And he will be taking us for the next 3 hours through the Ind-AS provisions. What are the difference between the Ind-AS as well as the Indian gaps? How we can do accounting under Indian GAAP, how we can do accounting under Ind-AS. So with this, I hand over baton to Mr. Ravi Ladia to introduce our today's speaker. Ravi, over to you. Ravi, are you there?
It is indeed a pleasure to introduce Mr. Zubin Billimoria. Mr. Billimoria is a graduate in commerce from the Mumbai University. He's a fellow member of the ICAI, an associate member of the Institute of Company Secretaries, and has a career already spanning 35 years. He has worked for over 30 years in Deloitte Haskins and Sells and SB Billimoria and Company, one of its associate firm. He is presently the proprietor of ZFB and Associates, a chartered accountant firm, and has been involved in the following areas for a wide spectrum of clients in different industries and sectors, including in all spheres of financial services sector, covering banks, financial institutions, broking companies, insurance broking companies, and mutual funds, along with real estate, hotels, and charitable trusts. He has provided statutory audits, tax audit, financial due diligence services, internal audits, regulatory and other attestation engagements, IPO filings, etc. Over the past few years, he has shifted his focus from the traditional audit-driven practices to serving corporates for ICFR and Ind-AS implementation. He has been involved in risk management, prudential norms, Basel norms, and accounting standards over the past few years. Some of the specific assignments undertaken by him in recent past are undertaking a feasibility study on behalf of asset management company, undertaking an overriding review of the draft order for sale order of equity shares of by a life insurance company, advising professional services firm in their assignment of framing the risk control matrices, conducting training for audit staff of Big Four professional firms, and undertaking study for machine tool manufacturing company on methodology for arriving at branch profitability. He has been a regular speaker at various forums like ICAI, BCAS, CTC, etc. He has also worked as a member of the study group of Auditing and Assurance Standards Board of the ICAI on drafting of revised guidance notes on various audits. He has also been part of the study group of AASB for advising in the accounting and auditing issues for asset reconstruction companies. He is a member of the panel for review of qualified audit reports constituted by the Financial Reporting Review Board of ICAI. He is a technical reviewer empaneled with the FRFB for review of audited financial statements. He is appointed as a resource person of the Expert Advisory Committee of the ICAI for drafting of opinions on accounting matters. He is also a technical reviewer of Quality Review Board constituted by the Government of India under the Chartered Accountants Act. He is a managing committee member of the BCAS as well as a co-opted member of their Accounting and Auditing, Journal and Corporate and Commercial Laws Committee. I can probably go on and on, but I would like to conclude by saying that he is also an author of many books on auditing NBFCs and corporate social responsibilities in India. To be really honest, if I wanted to write so much about myself, I would fall short of words pretty soon rather than completing this. So with folded hands, I would like to welcome you, Mr. Zubin. Please, the stage is all yours. Please share your wisdom with us today.
Thank you. Is it visible? Am I visible?
Yes, sir. You have to start the presentation.
I think, yeah. F5?
Yes, sir.
Yes, okay. A very good evening to one and all, to the organizers of the event, Mr. Nilesh Vitlani, Mr. Deepak, and Mr. Ravi. Also, I would like to thank the CTC and the FTAP for giving me this opportunity to be part of a long duration program, which I understand you are having. And today it's the 12th day of the program. Am I right?
Correct, sir.
Yes. So I'm sure it will be useful and not a cheaper by the dozen concept. And it will be something which will be much more worthwhile. I have been given the task of speaking to you on accounting and disclosures for real estate projects. The accounting under Indian GAAP will be the first part of my presentation. The accounting under Ind-AS, and once we have studied these in detail, we'll touch upon the key differences between Ind-AS and Indian GAAP which in any case you would be able to grasp during the course of the presentation, and which during the course of my presentation itself I will try to cover. Now, one thing is certain, that accounting for real estate has always had a checkered history and a somewhat controversial history also, both under Indian GAAP and to a certain extent recently under Ind-AS. Currently under Indian GAAP, as you all would be aware, the revenue recognition is really governed by AS 9. However, because of the peculiarities of real estate accounting and accounting for real estate projects, the accounting treatment for that has got carved out through a separate guidance note. See, earlier, what used to happen was that the accounting for real estate projects used to be equated with the accounting for construction contracts under AS 7, which typically draws down to the accounting under two methods, the percentage completion method and the completed contract method. And this was also a permissible avenue for tax purposes also, as far as my knowledge goes. Then what happened was that for real estate developers, or essentially for the non-construction part, other than the construction contracts, basically people who are involved in separate as developers for residential and commercial projects, there was a separate guidance note which was formulated in 2012, which deals with the accounting for real estate development, and which is to a great extent like what quite a lot of our accounting standards are, a rule-based prescription. When I say a rule-based prescription, it is a rule-based prescription in terms of certain aspects, quantitative thresholds, while determining the percentage of completion. And as you all know, the POCM, or the percentage of completion, is one of the key considerations in the accounting for the real estate projects. So that is the way, to a great extent, the rule-based accounting is what is prevalent under Indian GAAP as per the guidance note. The accounting for Ind-AS also initially we had the Ind-AS 18. Now there was some controversy as to whether you could follow really a percentage completion method, or you can only follow the completed contract method. To lay to rest that controversy, what was really done was, while Ind-AS 18 was applicable, there was a separate specific guidance note which the ICAI had come out with for the accounting for real estate projects to companies to whom Ind-AS is applicable, which again to a great extent was similar to our guidance note which we had under Indian GAAP. It talked about the same percentage of completion method, some rule-based thresholds for determining the percentage completion, and so on. Now that guidance note was withdrawn once the current Ind-AS standard on revenue recognition came into the picture, which is Ind-AS 115. So now that has done away with the separate preferential treatment, whatever you may call it, for the accounting for real estate projects. And now all real estate projects also, the revenue recognition and the other accounting aspects for that have to be dealt with in terms of the 5-step model which is laid down under Ind-AS 115, revenue from contracts with customers. Basically accounting for revenue from contracts with customers. So it is essentially, you have to be up in the business. You have to have customers who are there to whom you sell your real estate projects. And if that criteria is satisfied, you have to follow the accounting treatment thereof. So this is what is the general background which is there. So as I said, first let us concentrate on the Indian gap. Just to clarify, am I clearly audible? Am I audible?
Audible, sir. Very much audible.
Yes, sir.
Okay, so I'll continue. So as I said, first, we will deal with Indian gap and the accounting for real estate under Indian gap in terms of the guidance note. So the introduction, the scope, the revenue recognition criteria. The concept of a project is very important, as we will see later on with some examples. What constitutes project costs? The accounting treatment, which will predominantly focus on the POCM, the percentage of completion method. The accounting treatment for recognition of revenue. Specifically, we will deal with the accounting for TDRs, because as all of you who are connected with real estate would be aware, TDRs is an important concept which is there in the real estate market. The acquisition and the accounting for TDRs has also certain peculiarities and certain specific considerations which we will be looking at. And then we would go on to essentially the disclosures. So this is what we would be covering as far as the guidance note on real estate accounting is concerned. See, the objective of this guidance note is to recommend the accounting treatment by enterprises dealing with real estate as sellers or developers. That is what is important as compared to the construction contracts. So here they are basically sellers, or whether there is a seller of land or whether it is a developer of a multi-storied real estate complex, multi-storied, multi-building real estate complex, or whether it is the construction of a separate bungalow or a separate row house or a separate mall or a commercial complex. So this is basically, it is to recommend the accounting treatment by enterprise dealing with real estate. Now, what is real estate? It refers to land as well as buildings and the rights in relation there to things like your TDR, your slum development rights, and so on and so forth. So the enterprises which undertake these activities may be referred to as real estate developers. They may also be referred to as builders. They may also be referred to as property developers. So these terms are all synonymous, whether you use the term real estate developer or whether you use the term builder or a property developer. There are certain specific considerations where you are only selling the land. Where you are developing the land, there may be separate considerations. Where you are also accounting and acquiring certain rights which are there, the accounting considerations may be separate. We will be looking at all these aspects separately. So now, what are the types of real estate transactions which are covered? As I said, real estate covers either land or building or the rights in relation to that. Now, what are the different transactions in real estate which are covered? I think that is what is important. See, it refers to sale of plots of land without development. So that is also important. Just if you are purely selling a plot of land without any development. Now, this may also cover certain long-term leases which are there. So that is relatively simpler. It is like you are dealing with a sale of a good, land being in the nature of a commodity or a good without any development. The overall complications are virtually not there. You don't need to get into the POCM and try to identify what are the costs and so on and so forth, which is what is required for the development and sale of commercial and residential real estate, with or without an undivided share of land. So this part B is the real heart and soul of the real estate development accounting, where you are really providing a comprehensive service of development. Now, this development of residential and commercial purposes may involve a lot of other ancillary services as part of the entire real estate development project, which is what we will be seeing when we will be examining the concept of a project and what constitutes a project. And this commercial and residential development may be with or without an undivided share of land. Correct? It may be with the land or it may be without the land. But normally land is inbuilt into it, so the land is not separately identified. So when you basically as a purchaser acquire a particular property, it is presumed that you are also acquiring an undivided share of the land, but that land is not separately identified. It is presumed that it is already there. Then acquisition, utilization, and transfer of the development rights. Then redevelopment of existing buildings and structures. All your redevelopment, slum redevelopment, and so on, which happens. And then another peculiar concept which is there in the real estate industry also, which all of you would be aware, is joint development agreements. Now, as we will see later on, joint development agreements, the accounting treatment may be slightly different depending upon the nature of the arrangement. All joint development agreements may not necessarily come under the purview of real estate development accounting, especially under Ind-AS, as we will see later on. Because it depends upon what the nature of the arrangement is, what is the revenue sharing arrangement, and various other factors. Whether the developer and the real estate developer and the owner of the land only share the revenue from the sale of flats, or they have a share in certain other mode. We will be looking at all those aspects separately. Now, the guidance note does not cover transactions which are covered under fixed assets, government grants, assets, and intangible assets and leases. This is obvious. The guidance note, to a great extent, draws upon the principles which are laid down in Accounting Standard 7 for construction contracts with regard to identifying what are the various costs. Plus, at the same time, it also deals with the principles enunciated in AS 9 revenue recognition, which is primarily that recognition of revenue is when the risks and rewards of ownership are transferred. That is the concept under Indian GAAP. When we come to Ind-AS, we have to say bye-bye to risks and rewards, and the concept of control, performance obligations, satisfaction, and so on and so forth will come into the picture. So we will look at all those aspects. Whereas here, basically, the main principles for accounting are similar to what are laid down in AS 7, primarily from the point of view of determining your costs, and from the point of view of recognition of revenue, the principles under AS 9. What really this standard, this guidance note is doing and concentrating specifically is on the various costs which are there, costs which have to be identified, and the most important part which the guidance note really deals with is how to work out the percentage of completion, because that is really the heart and the soul of real estate accounting. POCM, or the percentage completion method, is the heart and soul. So it lays down various detailed parameters, both qualitative as well as quantitative, as we will see later on. Qualitative in terms of what level and what approvals and all you need to obtain. Quantitative in terms of what percentage of the total costs, which costs to include, which costs to exclude. whether what percentage of the revenue from individual sale contracts you have realized. So it goes into a fair degree of detail. So it is a combination of substance and a combination of form. The qualitative aspects have to be based on the substance, whereas the quantitative aspects are rule or form based. So it is a combination of both, whereas all these aspects will not really play a role when we will be looking at the accounting under Ind-AS a little later on in the presentation, because there it is primarily principle driven, not your 10% and 25% and so on and so forth, which we would be looking at under Indian GAAP. Okay. So now what is the revenue recognition criteria? I think these revenue recognition criteria are similar to anything else which is also laid down in the revenue recognition standard. Correct? There has to be an arrangement, even under Ind-AS contract with the customer. There have to be some products or some services which have to be delivered. Products may be the completed building, services may be certain other amenities like a swimming pool or a clubhouse and so on and so forth. You may construct a road and approachway. The consideration has to be fixed and determinable. Certainty of collection remains an important criteria for revenue recognition. So if any one of the above, any one or more of the above is absent or missing, the revenue recognition must be postponed. So these broad principles are similar to the principles which are laid down in AS 9. The guidance note also specifically elaborates on each of these principles. So this is nothing different really. The important thing is to quantify what is the amount of the revenue. That is what is important, apart from when to recognize the revenue. Now, as I said, the POCM, the percentage of completion method, is an important criteria. And for a percentage of completion method to be really applied, what is important is to identify the various subdivisions, identify the various jobs, identify the various projects within a commercial or a residential real estate development contract or a project. So now let us go into a very important criteria of identification of the projects. So for that, you need to first understand as to what constitutes a project. A project is nothing but the smallest group of units or plots or saleable areas for which there are a common set of amenities. And unless and until you have those common set of amenities, and without those you cannot, the plots and the flats and the commercial units are not really saleable and usable by the ultimate end users, you cannot say that it is a completed project. But at the same time, you have the freedom to bifurcate your projects. If you are taking up a project for construction of 4 residential towers, each residential tower may be a separate project, because that can be sold on a standalone basis. The individual customers can get the benefits on a standalone basis. There may be certain common amenities like a clubhouse or a swimming pool and all which may be there, which we will be seeing later. Those may be separate. For those amenities, the customers may also pay separately for that. They may or may not be mandatory. Everybody may not want to be a member of the clubhouse in its concept. Everybody may not want to avail of the swimming pool facilities within the complex. So they may pay separately. Whereas certain common amenities, which there may be parking lots which may be there, which may be sold separately. So all those are separate aspects. But if there are certain things, especially in commercial projects, where it has to be consolidated and certain ancillary facilities and amenities are necessary for the use by the customers or the users, then it would have to be taken together to be considered as constituting a project. So it has to be essentially functional on its own, has to be able to stand on its own feet, stand on its own legs. So it is advisable to split or divide larger ventures into smaller projects. The more granular you can go into identifying a project, the better it is for you to apply the percentage of completion method. Because the larger the unit, the more cumbersome and more difficult it will be to apply the percentage of completion method. So you can go into as much granularity as possible, but at the same time, the granularity should be such that it is functional, it is able to stand on its own feet. It constitutes a saleable product, a saleable facility, a saleable commodity, a saleable arrangement, and not just something which has been just cooked up to just try to shore up your revenue by applying the percentage of completion method. Okay, so this is where the project, what is the concept of project? Let us look at some examples and what are the factors, what are the practical considerations. See, here you consider that there is a developer who has purchased a big plot of land measuring say about 200 acres, and he has plans to develop 10 tower buildings for commercial and residential purposes. So these are 10 separate big tower buildings. It is a mix of commercial and a mix of residential. It will also have to construct a common road for the movement of the vehicles inside the path. Plus, as part of the contract, it has accepted to provide common clubhouse facilities. So now, how do we identify the project? See, one thing is certain, that each of the towers, 10 towers, can by itself constitute a separate project. So when one is completed, see, there could also be a situation where you may have to see whether he starts work on all the 10 towers simultaneously, whether he starts work on 2 towers at a time. So the work may be in 5 phases, or whether the work is started individually. Whichever way, he can then plan what constitutes a project. He may say that 2 towers or 2 commercial towers on the south wing constitute one project. 2 residential towers in the west wing may constitute another project. 3 residential towers and 3 commercial towers in the central wing may constitute separate projects. So that is how he may divide his 10 plots into different projects, 10 buildings into different projects. Or each of them may constitute a separate project. So it is up to him, as we will see later, that the identification of the unit for the purposes of identifying a project is generally left to the developer based on certain broad parameters which are there. Now, in this particular case, the individual, whether it is 1 + 1 + 1 or 3 + 3 + 2 + 2 or 2 + 2 + 2 + 2, whatever you may look at it, they could be separate projects. The common road which you are constructing, the cost of that common road would have to be allocated to the individual projects. So it is important and it is necessary and it is even common sense that the road construction has to be completed first. Because unless and until you complete the approach road, you will not be in a position to construct the towers, and nor will the people be able to move into the facilities. So unless and until though the common road cost is one, we need to ensure that we allocate the cost of common amenities and facilities to each of the individual projects. Now that has to be either on an allocated cost basis, or it can be done on a fair value basis, whatever is a reasonable basis. There are no hard and fast rules which are there. Now, providing of a common clubhouse facility to each flat owner. As I said, the clubhouse facility is a separate facility. One can argue that this providing of a clubhouse facility is a separate specific service. It is not really part of a real estate development project. It is a separate amenity or a facility which is followed. So as and when somebody wants to avail of the membership of that facility, the membership fees for that will have to be recognized separately in accordance with the principles laid down in AS 9. And you need not necessarily have to follow the principles which are laid down for real estate development accounting. There is no concept of a POCM and other things, because the clubhouse is that you do the construction of the clubhouse. The cost of that construction is what you load onto the individual projects, or you may not even load it onto the individual projects and show it as a separate cost of construction. And whatever revenue you get out of that, the fees you account for them separately. So there are various ways in which you can do this thing. If it is part of a contract or whether it is part of a separate arrangement, it all depends upon how it is, and depending on that, the accounting will have to be done. Okay. Now we go on to some further practical issues. Now, apart from the club, see, it has also planned to develop sports and swimming facilities, for which it is not doing it. There is a third party who will be providing this facility. And you can also allow outsiders to use this facility by collecting the charges, subject to the fact that there may be a limit on how many outside members can be there. So that is what you need to really look at. So here, when the sports and the swimming pool facilities are developed by a third party, so it is like a separate contract which that third party, so it is a separate project by itself. It is a separate service facility. Now, this is not really like a real estate development. This is a normal service which you have providing. So you need to follow the principles of revenue recognition under Ind-AS 9, under AS 9. And there also, for recognition of revenue from services, there are two options, or the main option is again in terms of the percentage of completion. So AS 9 specifically deals with the provision of services. And then whatever is the revenue which you need to collect would need to be accounted for, because there the revenue stream may be different. You will essentially be collecting one-time entrance fees, and you may also be collecting certain membership fees which will be there. So those then have to be accounted for separately in terms of the principles for recognition of revenue under AS 9, like how you would account for your membership fees. Similarly, parking lots also are separate. And there also you will be collecting a separate amount. The construction cost of the parking lot will be your cost of construction, and then whatever amount which you collect per parking area will be directly recognized as a revenue. Here there is no question of a POCM and all that. Then again, apart from the common road and the clubhouse facilities, there would also be some joggers track and a children's park. Now, this is again a common facility which is there, which is available for all the towers. You may or may not charge for using of the jogging track. You cannot keep track that only a person who has paid can go out and jog, because it is a common open area. Children's park, okay, you may probably restrict the entry, that only if you pay, you may be allowed to enter the children's park. So there again, you'll have to see jogging track. If it is a common area, the cost has to be loaded onto each of the individual projects and allocated to the projects. Whereas children's park, again, you may allocate the cost, but whatever collections you do will again be periodic. So those will be in the nature of membership and subscription. So as I said, in each of the above cases, what really constitutes a project, what has to be separately identified, like your swimming facilities, sports facilities, clubhouse, or what is common, like your common road, jogging track, children's park, and so on, all needs to be separately determined. So are we clear on this part? This is where the practical challenges will be there. What is important is that the identification, there are no hard and fast rules. It all depends upon individual case to case. It is generally left to a developer. There is no accounting policy choice involved. It is just a question of common sense determination. Business and commercial considerations have to be kept in mind. Clear? Now there are some other specific practical issues. Now consider a company which has been given a contract for construction of 10 petrol pumps at different locations. It has been given a single contract, but the assets are not interrelated. They are first of all spread all over the state or even all over the country. So though you may have entered into one contract, construction of each petrol pump is considered as a separate contract. And now we all know that petrol pumps also are out for commercial exploitation. So they will in turn basically have arrangements for setting up some food store, a small supermarket, or maybe a pizza parlor, or any such thing. So that will all be related to each individual petrol pump. So there also the facilities, the revenue arrangements from that may have separate considerations. So each of these would be separate standalone contracts. There may be an umbrella master arrangement or an umbrella master agreement, but then each contract at each location for each petrol pump setting up would be a separate contract. Similarly, a constructing of a hotel. Hotel, not only the residential part, but the health club, swimming pool, restaurants, and all are separate. And normally, as far as constructing a hotel is concerned, it is generally practically a lump sum price which is normally paid. So all the assets are interrelated. Negotiation is also combined, so you treat it as one single contract or project. So when you really are given a contract for the construction of a hotel, you cannot say that it is separate. Normally, it is an integrated whole. That is generally the practice as far as hotels is concerned. Similar considerations may also apply to shopping malls. The developer may be charging separately, or he may charge together. So all these are the practical issues which you would need to keep in mind while basically identifying what constitutes a project. So I think this is very important, because only then you would know what costs to consider, whether separate costs, what are the common costs which have to be allocated to the projects, revenue, what portion is under the POCM, the actual main part regarding the construction and development, the ancillary services where you collect charges. There is no concept of a POCM. Those are just revenue which you recognize as and when you collect the subscription charges, membership fees, usage charges, and so on and so forth, for clubs, sports facilities, swimming pools, or use of a children's park, for example. So clear? Now we move on to basically project costs. Now, what constitutes project costs? In AS 7 also, we have seen what constitutes construction costs. So now that gets substituted for what constitutes project costs. As we all know, in real estate, the cost of land and the development rights for the land, stamp duty, brokerage, rehabilitation costs to displace the people, to rehabilitate them, to give them temporary accommodation, all these constitute a major chunk of the cost. As we all know, land cost is the single most important cost for the construction and real estate industry. The next important cost component of the cost is the borrowing cost. Borrowing costs, in accordance, I think, just pardon the reference. I think instead of Ind-AS 23, we have to refer to it as AS 16, because we are talking of Indian GAAP, though the principles are the same. The only thing which you have to note as far as the borrowing costs is concerned is that any abnormal stoppage of work, if it is there, now if because of this corona COVID lockdown, if the work has stopped for a period of time which is other than the normal, you cannot continue to load your borrowing costs. Similarly, if you have foreign currency borrowings, to the extent it is considered as interest, as determined in terms of the principles in the borrowing cost standard, it would have to be loaded. You need to have a comparison between what is the rate if you would have borrowed under Indian GAAP and the concessional rate which you are getting, and the exchange difference. To the extent of that difference is an interest cost, and the balance will be an exchange difference. So even that will have to be loaded. So determining what amount of borrowing cost you need to load on to the project costs as part of the construction costs, as part of the real estate development costs, is an important criteria. Because after the land cost, the borrowing cost is the single most important cost. And then you come to the actual operation cost, the construction and development costs, all costs which are directly allocated and attributable to the specific projects. Your material, your labor, and all those direct related costs which are there. Hiring of your equipment and all those. So these are the three broad components of the costs. Some of them may be direct construction costs, and some of them may be allocated costs. The same principles as we follow for inventory valuation will to a certain extent also apply for allocating and capitalizing the costs as part of your WIP or the construction costs. So land conversion, sorry, spelling mistake, conversion cost, not conversation cost, sorry. Site labor. Labor is the most important. Cost of material. Depreciation on the plant and equipment. Any freight costs on the material. Hiring of your cranes and all other equipment. Cost of design and technical assistance. Another important cost is your expected warranty cost. I think this is very important. This I find is an often neglected area, warranty costs. Many times in terms of the contract, there is a clause which is laid down that say in the initial period of 1 or 2 or 3 years, some free replacements may be provided for certain damages which may be done, which may happen. So you have to estimate those costs upfront and make a provision for those costs in terms of the principles laid down in Accounting Standard 29. So that warranty cost also is part of the construction and development costs. It will be on an estimated basis, but you have to load that cost. Very often this aspect is overlooked. Sometimes there may be some third-party claims, litigation costs, and so on and so forth. To safeguard your interests, to carry out the commercial transactions and all that, you may have to, in certain cases, settle a lot of claims with third parties, whether you like it or not. It's all a part and parcel of business in our country and elsewhere also. Insurance. These are all the normal types of project costs which are there. The normal administrative and general overheads to be allocated, which are directly attributable. Your security charges on the site, your power and fuel, electricity, all these are your normal overheads, your factory overheads, how you load it onto the inventory. Similarly, your site overheads, also you have to load it on. Now, this is where you take it on the basis of the normal level of activity. When we say normal level of project activity, what do we mean? We mean that basically you have to allocate it over the various phases. If suppose the earlier example, what we saw is a project where there are 10 plots, 10 buildings. Whatever is the total common electricity cost at the site has to be allocated in the normal ratio of 1:10 to each of the individual projects. Or suppose if out of the 10 projects, you are only starting work on 2 projects. So then the electricity cost has to be equally divided amongst the 2 projects. So what is the project activity? What is the level of activity which is taking place at that particular point of time? You need to identify that level of activity and basically allocate the project costs accordingly. So these are all small nuances which you need to keep in mind when you are allocating the projects. Very important. There has to be a proper scientific basis. There are no hard and fast rules, but at the same time, it has to be common sense, logic, and commercial considerations also need to be kept in mind. This is really the heart and soul of your real estate accounting, accumulating all the project costs. Now, what do we exclude? Oh, sorry, prior to that, in case of slum rehabilitation projects, the cost of rehabilitation has to be included as part of the cost of land. That is very important. That is a major component of the cost in slum rehabilitation projects. You are displacing the existing occupants. You have to give them some alternative accommodation. So whatever payments you are making for that alternate accommodation will have to be loaded onto the cost, a very important component of the cost. Now here there is another practical consideration. Cost of a sample model flat. How do you treat it? There is no ready answer. Some of them may take a view that model sample flat, it is like a promotion. So it is like a selling expense, so it cannot be part, it has to be charged off. That is one view. The second view is that is it going to be available for sale subsequently? If it is going to be available for sale subsequently, then the cost of the sample flat can also be treated as part of the cost of development and construction. So it all depends. If it is just a model or a prototype which you have developed, that is more in the nature of a selling expense, which you need to charge off. Though, of course, there are strong views that it is really for basically bringing in your customers. And since it is for bringing in your customers, it is essentially in the nature of a selling expense. So it has to be charged off. Now, this is the position as far as selling expenses is concerned under Indian GAAP. As we will see in the next slide, general administrative and selling and R&D costs have to be excluded. That is a normal principle even as far as not loading these costs onto inventory. So even under the inventory accounting standard AS2, all these costs are excluded from the valuation of inventory. Marketing costs also directly relating to the project cannot be considered. Now this I have highlighted because this is the position under Indian GAAP. Whereas when we will look at under Ind-AS 115, the situation is different as far as selling costs are concerned. So there the selling costs and marketing costs in certain situations can be considered as part of the project cost. And there is a separate and specific accounting treatment which is permissible for those selling costs. Similarly, as far as research and development costs is concerned, see, those of you who are familiar with the accounting standard on intangible assets, it talks about two things. It talks about research costs and it talks about development costs. Normally, any costs incurred during the research phase have to be charged off. Costs for the development of designs or any other technical assistance, as we saw in the earlier slide, cost of design and technical assistance, such type of development costs can form part of the construction cost. It is like the principle under the intangible assets standard, the development costs can be capitalized. Once you know that there is a ready model, so here also for construction, for your architectural designs and all those other things, various such related costs, you can capitalize it. But the research costs as to what sort of materials you may use, if you are trying to use a new type of chemical or a new type of material, which is still not proved, the commercial viability, the technical viability of that, if it has still not been proven, you are just in the research phase, those costs have to be charged off. See, these are all very important things. These are all small practical considerations which you need to keep in mind. Generally, people tend to capitalize all these items also. It is very important as to what you should capitalize and what you need to expense of. So the pure play research and development costs generally have to be charged off unless it is something where you have actually developed the design, it is something which is proved, it is something which is commercially feasible and viable, only then you need to capitalize. So only such specific technical assistance costs, technical development costs have to be capitalized. So even sometimes the dividing line between what needs to be included and what needs to be excluded is very, very thin. You need to be on the guard and you need to be careful with all those things. So are we clear on this? Is the pace of the presentation okay?
Sure, sir. This is perfect.
Perfect. Yes.
Yes, sir.
The other thing, do you want questions at the end of the Indian gap part, maybe for 5 minutes?
Sure,
Or
sir.
do you want all the questions in the end?
No, we can have questions in between.
So once I finish the Indian gap part, I think we can have a 5-10 minute question answer session, and then I can go on to Ind-AS.
Sure, sir.
So maybe you can instruct the participants also accordingly to keep their questions ready.
Sure, sir. So
Okay.
participants, you have heard sir suggest that we take questions for the first part of the presentation right away after
Yes.
it is over.
After I finish the Indian gap part.
We already have a couple of questions, sir.
Yeah, whenever. Okay, so I thought that I'll just sound you off in advance. I should have actually mentioned that in the beginning.
No issues. Thank you, sir.
Yeah. So this is inclusions and exclusions. Now we come to the next part. What is project revenue? As I said, project revenue includes revenue from the sale of plots. That is the sale of land, sale of finished and semi-finished structures. See, even on a building which you are constructing, some of it may be incomplete and you are still making the sales. Or after the building is entirely completed, also you may make the sales. The considerations are totally different. Once the construction is over, there is no headache. There is no POCM and all that you have to do. Whatever amount you get, straight away you book as revenue. Consideration for amenities, interiors, parking places, sale of development rights. So these are all the various components of a project revenue. And as I had mentioned, if there is one large contract with various elements, then whatever is the total contractual consideration, you may have to allocate it, and generally that is done on the basis of the fair value of each element. Now, when I say fair value of each element, it basically means that if you were to sell those things separately, what would be basically the cost individually, which would be attributable. So that is how you then allocate it. See, of course, ultimately, whenever you do any form of allocation or adjustment or estimation, you need to keep in mind the materiality considerations. Because materiality is always an overriding consideration. Okay. So these are the various types of project revenue. See, revenue from the sale of plots is relatively simple. You have sold the land and you book it. You are not doing any further development. Sale of finished and semi-finished is where the actual development and construction is happening. So that is where mainly the accounting, POCM and all comes into the picture. Amenities and interiors also. Basically, the revenue may be on the basis of, if it is an amenity like a clubhouse which you are constructing, similar principles. But if it is something like a parking lot or a, then basically the revenue recognition considerations are separate, because there it is more in the nature of a subscription revenue rather than a revenue which is to be allocated on the POCM basis. Okay, so this is how the project revenue. Most important criteria for recognition of revenue is to determine whether significant risks and rewards associated with the ownership are transferred in substance. So now how we will see how we can determine that. What is it that we need to look at? We need to first look at the terms and conditions of the agreement. The determination of the agreement with the buyers is very important. And this agreement normally is entered into at the initial stage of construction. It may not necessarily be an agreement, sale agreement, but it may be an agreement to sell, but not an actual sale agreement. but it identifies basically what are the various rights, what are the various obligations, what are the payment considerations, and so on and so forth. When possession passes, when it does not pass. See, normally, as we said, that the legal title will only pass once you get all the NOCs, the building NOC, fire NOC, and so on and so forth. But you may still be in a position to legally enforce your rights. Significant risks and rewards have already been transferred to the buyers, to the proposed buyers. So it is because of that we can take the recognition of revenue based on the percentage of completion method. So that is an important criteria. Whereas, as we will see under Ind-AS, this criteria may have some different dimensions. So we will look at that separately under Ind-AS. There it is the full control. So there it does not look at the substance, significant risks and rewards. Because if you have entered into an agreement, the agreement, if it is to what extent it is legally enforceable, what are your rights? You may not get the actual possession, but you still have a certain rights as the buyer. So it is because of which that the entity which sells to you, which does the real estate development, is able to recognize revenue on a percentage completion basis. Even if a real estate, basically the buyer and the seller, so what is more important is the agreement and the terms and conditions. So as I said, if the sale agreement is legally enforceable and it transfers the significant risks and rewards, it is considered as satisfying the condition for revenue recognition. And which is what normally is the criteria. I'm sure all of you must have the legal implications of all those things. I'm sure all of you would be aware and you would have covered it during the course of your deliberations over the past few weeks. What is important is the economic substance of the transaction, the conduct of the parties and all that. So the substance of the arrangement is very important. Substance of the arrangement is important for determining the revenue recognition, whether you can recognize revenue. Then once you have determined that you can recognize the revenue, then form comes into the picture in terms of how to determine the POCM and what quantum to recognize. So there is a combination of substance and a combination of form, both. Now, as I have told you, there are different forms of project revenue. So there may be different considerations. See, some of the things are pretty straightforward and need to be accounted for as per AS9 at a point of time. There is no question of any POCM being involved in this. Sale of land, sale of TDR, and sale of constructed units. So that is the first part. That is relatively straightforward, like how, I mean, a completed constructed unit, when you sell a flat, you straight away recognize the revenue. You may receive it in installments, that is future installments. Receivable is a separate thing, but the revenue is recognized because you have already risks and rewards, control, legal possession, everything is transferred. Sale of land with significant development or construction, then you have to apply the POCM method. So this is where the heart and soul, the second part. The first part is not really real estate development accounting. That is like any sale of any item, sale of commodity, sale of property, sale of good, whatever it is. The second part is where the sale of the land with significant development. As I said, it may be an undivided share of the land. So you may not even know what the land component is. What is important is the development component or the construction component is what you are recognizing as revenue, because that is the service which you are really providing. You are not really selling the land, but you are developing or constructing on the land, and that is an important part which is there, which you are doing. So it is the second part really, which is the important part. So as I said, the above, what are the conditions? Transfer of significant risks and rewards. There is no uncertainty. I think it is important that this uncertainty criteria is fulfilled. See, many times people may just do a token booking and then bulk of the amount comes on delivery. So now in such situations also, whether and to what extent you can recognize revenue, we will see that, because there are some guidelines and rules which are laid down in the guidance note. Now, sometimes in certain situations, if the agreement specifies that transfer of legal title is a condition precedent to transfer of risks and rewards, then revenue can be recognized only at the point of transfer of the legal rights. So these are all legal considerations which you need to see. So it is important that if you as accountants or as auditors sometimes have to take legal help also as to whether significant risks and rewards of ownership have passed or not. Or normally, whenever any agreement is entered into, the company itself may take an independent legal opinion that by this agreement, significant risks and rewards are passed on at this point of time, and so it will be okay. So legal intervention may be required more often than not to determine whether all these criteria are satisfied. Okay. So now once we have determined when to recognize the revenue, now how much to recognize is the most important thing. So this is where we come to the heart and soul of POCM. Now, when do you apply POCM? Naturally, if it is a long duration contract, project is more than 12 months, and which most of the construction contracts are. Individual units are interdependent or interrelated, and construction and development activities form a significant proportion of the project activity. When I say significant proportion, I am not saying significant proportion of the cost, but a significant proportion of the logistical activity of the project. The land cost may still be the most significant, 70%. The development construction cost may be 30%, but that 30% cost, incurring of that 30% cost may logistically take you 5 years. So that is a significant portion of the project activity. So that is where long-term construction contracts are where POCM has to be applied. Short-term, normally, if it gets over within 12 months, then there are no issues. There is no question of a percentage of completion. So are we clear on this? It has to be for long-term construction contracts. If you know at the start, at inception itself, that a project will be completed short-term within 12 months, then there is no question of a POCM. Everything is all done within an accounting period or within 1 year. Now, POCM, what does it mean? Percentage of completion means that you need to recognize revenue when a certain percentage of the work is completed. So now, how to determine and at what point of time you need to see. You have to first be in a position to estimate the total project revenue. That is the first thing. The benefits from that revenue will flow to the company, and a reliable estimate of the future project costs. Because ultimately you need to determine the estimated costs of completion, the future project costs of completion. And then you need to determine the stage. So there are three criteria: total estimated project revenue, total estimated project cost, and what is the stage of completion. So that is a percentage which you need to arrive at. Now, how you arrive at that percentage? So first of all, these are what I told you in the beginning, the qualitative criteria and the quantitative criteria. So you can start recognizing revenue only after certain conditions are met, certain qualitative criteria are met, and certain quantitative considerations have been satisfied. So one thing is there, as you all may be knowing, any real estate or construction activity, whether residential or commercial, needs a lot of clearances. What is important, the standard says, or the guidance note says, is the critical approvals should have been received. Critical approvals for the commencement of the construction, like environment clearance, your approval of plans and designs, the title to the land is clear, agricultural to non-agricultural usage change, and so on and so forth. Any RERA implications, if any, also need to be considered. Those are all legal matters. I am not going into it. I'm sure all of you would have factored in. What is important is the critical approvals. These are some examples of critical approvals which the guidance note has given. Then there has to be some reasonable level of progress. You can't just dig a foundation and then stop and start recognizing revenue. At least 25% of the construction and development costs other than land and borrowing costs. Because if you recollect, we saw in the slide that project cost has three main components: land cost, borrowing cost, and the construction and development costs. What we need to look at here is that 25% of the construction and development costs should have been incurred. So you need to know and estimate, first of all, what is your total estimated construction and development costs. We saw what are the various construction and development cost components. So you need to estimate all that. At least 25% of that cost should have been completed. First is, of course, critical approvals. You may have incurred 50% of the construction and development cost, even excluding land and borrowing costs. But if the critical approvals are not obtained, you cannot start recognizing revenue. You may have received all the critical approvals, but if you have incurred only 10 or 15% of the construction and development cost, you cannot start recognizing any revenue. 25% of the saleable project area should be secured by contracts with buyers. You have to enter into contracts with buyers, agreements with buyers. So that itself is the first important criteria. That is the most important criteria, that the contracts with the buyers, at least 25% of the saleable area. So you should have entered into contracts with your customers. Now there again, whether a letter of allotment which you have issued constitutes a contract, or whether a stamp paper contract, I don't think that is really an important thing. Is in substance, have you entered into a contract with the customer? It has to be something which is an enforceable document. And that has to be for 25% of the saleable area. Now, that 25% of the saleable area depends upon what you consider as a project. In the earlier example which we saw, If there are 10 buildings and the 10 building each constitutes one single project, then you have to say 25% of the saleable project area of all the 10 buildings. But if you identify that 2 commercial units on one side and 3 residential units are all each of separate projects, then you have to see that within the individual projects, within those 3 buildings, 25% of the flats or the saleable area has been sold and contracts have been entered into. So that is all again with reference to how you have identified a project. So that is why the first stage, the identification of the project is important. And then only you can know the total cost also. Now the costs also, estimated costs of construction and development also has to be for the separate projects. And 25% of the saleable area also have to be for the projects have been secured by contracts with buyers. Another criteria also, you may have entered into for 25%, but you must also collect at least 10% of the contract consideration. If the cost of the sale value of the flat is 1 crore, you need to collect at least 10 lakhs. It has to be realized, and you are in a reasonable position to ascertain that the balance amount will be recovered. You are not selling to some bankrupt fellow, or you are not selling to some company who is a willful defaulter, or you are not selling to somebody against whom some legal dispute is going on and it may be difficult for him to fulfill his obligations. To some Vijay Mallya or Nirav Modi or similar parties, if you sell, you may not be able to do, you may have got 10%. So you should also be in a reasonable position to expect that the balance amount will be recovered as per the terms of the contract. And as I said, each contract and each project should be considered separately and not on an overall basis. Okay. So this is where the critical accounting comes into the picture. See now how to apply POCM, I'm sure all of you know. Revenue and recognize cost to completion. It may be based on a technical estimation, survey, and so on and so forth. One of the common methods is based on the actual cost. Sometimes you may not consider the cost, but you may determine the percentage completion even on technical basis. One thing is certain, that whatever revenue you recognize should not exceed the computed project cost. You cannot exceed, which is as per the revenue recognition should not exceed the revenue computed as per the project cost incurred. So ultimately, even if you may determine based on a technical survey that 34% of the work is completed, but if based on your percentage completion of the cost, the total revenue is only up to 27%, you have to limit your this thing up to the extent of 27%, because that is the total percentage of the work completed. Clear? So technically you may feel that 34% or 35% of the work is completed, but only 28% of the cost is incurred. You recognize revenue only to the extent of 28%. But if you determine that your total cost to completion percentage is 35%, but as per some technical survey, only 28% of the work is considered completed, you may recognize revenue to the extent of 28% and not 34%, even though the cost incurred is higher. So these are also again some of the factors which you need to keep in mind. See, these are all practical things which I am trying to tell you. Profit should recognize only to the extent of work performed. If there is any loss, it should be expensed out. Revenue should not exceed the estimated revenue. Now here the last point is important. If there is any default, then the whole of that contract cannot be considered for revenue recognition. Now this is a harsh criteria. If a person has paid the first 20%, but then he is in default. The revenue which is recognized earlier will also have to be reversed. Now that is a debatable point, considering that you have already realized the money earlier. So that is also important. Ongoing performance of the contract is of critical importance. It should not so happen that a customer just pays the first 2 installments and then sits on it. If there is a milestone schedule which is laid down, he needs to adhere to it. So this is again an important criteria. Now you may keep on estimating that the percentage of completion changes. So that is accounted in the period of change. Sometimes a cancellation of a contract may also happen, and some part you may say that now instead of constructing, we'll use it for our own purpose. So then the percentage completion changes, the cost needs to be reversed, revenue which you have recognized also would need to be proportionately reversed. And then that cost ultimately will be considered as capitalization of fixed assets. Okay. Now we just go on to the acquisition of TDRs. There basically, see, TDRs is not that much. The cost of acquisition of the TDR will be part of the project cost, because TDRs are normally acquired as part of some project. It is an incremental benefit which you are getting. Sometimes the TDRs may be acquired by giving up rights over an existing structure. These would need to be recognized and recorded at the fair market value in terms of AS 26, because it is like an intangible right which you have given up. Now, suppose sometimes your TDRs, if you have acquired by way of agreeing to construct a built-up area, the cost of acquisition shall be the amount spent on construction of the built-up area. So any construction which is there of the built-up area or cost of acquisition, these are the incremental costs which we have to be loaded. It is part of the normal project, because ultimately TDR is connected with the project. Now, finally, we come to all the disclosures. Any accounting standard, any accounting guidance note, disclosures are the end part. That is like a report card of all whatever accounting and all you have done. So all these project revenue recognized, methods used to determine, stage of completion, projects in progress, the WIP, the aggregate costs incurred, advances received. All these are just the normal things, I think, which all of you are already used to, once you have determined all this. So with that, we have come to the end of the first part. I think this is the more important part, because most of you, I believe, would still be a relatively small and medium practitioners to whom Indian GAAP would be applicable. There are a lot of intricacies which you need to keep in mind. A lot of areas where judgment calls will also need to be taken. It's all very important. Maybe we can take questions for about 5-7 minutes, a couple of questions. Can we?
Yes, sir.
Yeah.
We can take the question, sir. I'm taking the first question.
Yes.
So the first question is from Shri Paresh Bagreta ji. He's
Yes.
asking that if a customer pays 10 lakhs as advance booking for an under construction flat, assume that the company is required to book a profit of rupees 1 lakh on POC method on this flat booked by customer. Advance of rupees 10 lakh will appear on the liability side of the balance sheet as at the end of the year. But how to pass an entry for booking the profit of rupees 1 lakh under which the account said this amount of rupees 1 lakh will appear as a credit side?
No. First of all, is he eligible to book that? Why is he saying 1 lakh profit? What 10% first of all is not a criteria. If he wants to book a profit, first of all, under the percentage of completion method, 25% of the cost has to be incurred. So minimum, I think, profit also which you can book. I mean, you will have to book it. You have to first see whether he is entitled to recognize the revenue. Just because an advance is received, then you cannot book 10%. How has he determined the 10%?
Okay.
See,
So then,
how is the 10% determined? Just
but
because
basically, he has taken a. I think he has taken 10% as the example. His question probably is that how this the revenue booking will
see,
be done in the
revenue
financials.
booking revenue booking depends upon all these criteria which I have indicated. So that, first of all, to what extent he is eligible to book the revenue, that will automatically, that itself the profit will come, because he would have incurred all the costs. Whatever advance is received is of no relevance. 10% advance received may be one of the criteria, along with the fulfillment of the other two criteria regarding critical approvals. 25% of the saleable area is sold in that project, and a minimum of 25% of the development and construction costs is incurred. So has he first satisfied that criteria? If he has satisfied that criteria, then he would be able to book revenue to the extent of whatever, to the extent of 25% of the advance amount received.
Assuming 25% of the work is completed.
Yes, assuming 25%, so then he can, essentially, he can even book to the extent of 25% of whatever amount he has collected.
As revenue.
Yes,
As revenue.
Revenue, because that is the amount which is due to him as per the agreement. 10% advance is what is due. And if he satisfies the other thresholds, then he can book the revenue. There is no correlation that 10% collected, so 10% profit. That correlation is not. The profit has to be determined. The revenue profit, when you say, there is no question of profit, there is a question of how much revenue you can recognize.
Yes.
So when you recognize revenue, automatically your profit gets booked.
Yes. And the final net profit may be determination of a lot of other factors like work in progress.
Yes. This is only one part. Absolutely.
Yeah.
I think that is a common myth, according to me, which is there. See, you need to book revenue based on certain criteria. You don't need to go as to how much money you have collected. You have to go as per the cost, and the other factors also now come into the picture.
So the second question is from Abhirup Agrawal.
Yes.
If in JDA the landowner maintains land as inventory and gets the flats constructed in exchange and sells the same to buyers individually, how should he recognize the revenue? POCM should be applied in such cases.
Just 1 minute. Just 1 minute. Madam, I'm in the middle of a training session. Can I call you later? I may take post 8 o'clock. Because thank you. Sorry.
So the question is that if in JDA, if the landowner maintains land as in inventory and gets constructed flats in exchange and sells the same to buyers individually, how should he recognize the revenue?
See, here if he is recognized, if he is selling the flats, then basically revenue, what is the revenue recognition arrangement is important. Revenue recognition arrangement is important. He gets the revenue at a certain percentage. He will have to share it. The accounting principles will remain the same. See, he may have incurred a cost for acquisition of the land. So he has paid the landowner the cost of the land. And then it is a joint development. So he will then be sharing the revenue, say 60-40. So to the extent, basically it is the same principle. Only thing is the revenue, how much percentage he shares, that will have to be considered while booking the revenue.
So the next question
principle remains the same. It is if he has a land which is there and he develops it. It is the same like any real estate development contract.
So just an aside for this same question, what the landowner may not have the records of what has been the expenditure incurred versus the total estimate of cost.
No, it is not the landowners is not important. The real estate developer is important.
Okay.
The landowner, basically, he has the land. He is interested in encashing the value of the land. So the real estate developer, the basic land cost is the cost which he has paid. The revenue which he will get will be as a sharing percentage.
Okay.
So it is like any real estate development, same principles.
Another question is that commission paid for the sale of flat, it is a part of marketing cost. If it is charged directly to the PNL,
It has
will
to
it,
be charged to the PNL under Indian GAAP. I will come to the treatment under Ind-AS separately.
okay, and so will it form the part of POCM?
No, it has to be excluded.
Yes, it has to be excluded.
Very clear, it has to be excluded.
So the another question is from Sri Jatin Saraogeji, that
Yeah.
how and when a landowner should recognize its share of revenue in case of revenue sharing based on JDA or collaboration agreement?
The landowner will recognize revenue as and when he receives it. See, whenever the real estate developer will give him a certain percentage based on the sale of flats and all which has happened. So there it is based on the understanding and the arrangement between the real estate developer and the JDA landowner. That is not part of a real estate transaction.
No, this case is of revenue sharing, so as against
A revenue
area.
sharing, but that it depends upon the arrangement when the revenue is due.
Right.
That is based on the contractual commitments which are there.
Okay. Or maybe can he take a certificate from the developer saying that this is the percentage I have recognized?
Yeah, he has to take it. He has to basically take it based on that. So not only a certificate, but see, there will be an understanding between the developer that as and when, see, it may be that as and when a developer sells a flat, a certain percentage of the revenue. One minute. Kashmir, I am in the middle of a trading program. Michelle no bhi phone aave na, હું પછીથી જરા વાત કરું. મને 8 વાગશે મને. હાજી, thank you. There basically, see, it depends upon the individual arrangement. Suppose, see, some joint development agreement may say that whatever are the sale proceeds which the developer corrects, 40% of that will go to the landowner.
Right.
So there he has to be satisfied, first of all, that the sale proceeds are realized. There may be a situation where it is only on the basis of the sales value. So if it is on the basis of the sales value, then we have to see that the contractual as per the value, as per the criteria, this is the total sale amount which is there. He may not have realized, but the revenue at least is what he is entitled to book. And a certain percentage of the revenue which he books. It all depends upon the case-to-case basis.
So the next question is from Sanjay Rathiji.
Yes.
In case of an SRA project, if
Yes.
revenue is by way of TDR only, how to account the TDR received after the completion of certain percentage?
Same criteria. It is ultimately, it is linked to a project, right?
Yes, sir.
So it has to be same criteria, PUCM only.
POCM only.
Yeah.
Then this is the last question which I am taking as of now.
Yes, yes.
Instead of applying percentage of work completed to estimated project revenue, will it not be better if only billed and realized portion of the revenue is recognized as revenue against the corresponding apportion cost-based percentage on completion method?
That can be better if it is lower. If it is lower than what comes as per the PUCM, it cannot be higher than what comes as per the percentage of completion.
So you can continue with the session, sir.
Yeah.
You can
So
continue with
before
the
that,
presentation.
I have one question from my side, sir, if you permit.
Yes.
So can one take a pretext that this is only a guidance note and not a
No.
statement? So
Now, guidance note also are authoritative pronouncements, I think, of the institute. They carry the same weightage because there is no corresponding revenue recognition standard for real estate.
Fine.
So I think that is now a no-no. It is a dangerous proposition.
Fine. Thank you, sir.
I'll just take a 2-minute bio break and come, please.
Sure.
Just 2 minutes, please. Yes, we can start, please. Sorry.
Sir, you can start your presentation, sir.
Yes.
Yes.
Now we go on to the second part under Ind-AS. Now there are different sets of complications which are there. Maybe calculation wise, there may not be too many complications like they are there under the POCM and all that. Here it is more of substance and when control is transferred and all that. Because as I indicated to you, the guidance note which is there now is withdrawn. The guidance note, and which was something which was broadly similar to what was there, what we have studied. So now since last year, Ind-AS 115 is applicable. And then there is a press release which is there. See, there is a common myth which was there, common misconception that once 115 has come in, you cannot recognize revenue on the percentage of completion basis. Now that is not correct. So that press release, which the institute came out with some time back, I think it has clarified that there is nothing that you cannot book, but you can book percentage of completion method, but it should be on the basis that the performance criteria are satisfied. Because as we will see, one of the important criteria for recognition of revenue under Ind-AS 115 is basically satisfaction of the performance obligations. So that once they are satisfied, and we will look at that part mainly with a couple of examples as to how it practically will work out in the Indian scenario and under what circumstances you can recognize revenue on the percentage completion basis. That is where I think the structuring of the contracts will play a key role to enable you to determine whether you can recognize partial completion method. I'm not saying percentage completion method, whether you can recognize revenue over a period of time rather at a point of time. So we should now get out of the thing of PUCM under Ind-AS. It is only whether you can recognize revenue over a period of time or whether you can recognize revenue at a point of time. Those are what are important considerations which are there. At a time means it is percentage, at a time means completed contract method. That means that there is a single performance obligation. And quite a lot of the contracts will now fall under the single performance obligation criteria, especially the non-real estate, not non-residential ones. Residential ones, at least you can still take a stand. So we'll just see. So there is a 5-step model. Then there are specific provisions for contract costs. See, especially mainly things like your selling and distribution costs and all that, you can amortize them. Unlike under Indian GAAP where you have to charge them off. And then the disclosures. So this is the 5-step model, which when you start getting into any revenue recognition, you need to satisfy them. Whether you are a real estate developer, whether you manufacture and a manufacturer, whether you are a service provider, whether you are a professional, whatever it is. Any revenue, it has to follow. So the first step is identify the contract with the customer. There has to be a contract. It has to be with the customer. You may get some grant from the government. Government is not your customer. You may get something from your subsidiary company. Subsidiary company is not your customer. Determine the transaction price. Allocate the transaction price to the performance obligation. And the last thing, recognize revenue at a point of time or over a period of time. So at a point means completed contract, percentage completion is over a period of time. But that is also again not percentage of work completed, whether your performance obligation is satisfied. When is the performance obligation satisfied? So contracts basically, they have to be written, oral or implied. That is, these are the general principles which are laid down in the standard. Now, the oral contracts will normally never come into the picture as far as real estate is concerned. So let us forget that part. It has to be an enforceable contract and it has to have commercial substance. Let us understand what constitutes contract with customers, which will be within the scope and outside the scope in terms of real estate companies. We just look at some cases. Here there is a case where there is a company A which is in the business of buying and selling commercial property. That is its business. It sells a property to purchase a P. It is an in-scope contract in terms of 115 since it is the output of A's ordinary business activities and hence P is considered as a customer. However, you take a second scenario if A is a manufacturing entity and it sells its corporate headquarters, the entire building, to P. It is out of scope since selling real estate is not its ordinary business. It is a sale of a fixed asset. So sale of fixed assets are outside the scope of this standard, even if it is a property. Clear? Then let us even go further. Joint development agreements. See, joint development agreements, some of the joint development agreements, I purposely did not bring out that part when this question on joint development came in, because certain joint development agreements may be in the nature of a joint arrangement. Because there may be a sharing of not only revenue, but also the sharing of the cost, sharing of the assets, liabilities, etc. So you need to look at that, is the landowner in substance selling the land to a property developer? If the landowner is selling the land to a property developer, then basically he is not in the business. So the landowner straight away sells it to the developer. So as far as the landowner is concerned, whatever amount the developer pays him is his revenue straight away. So that part of the transaction is over. Then the developer provides construction services. That is also clear. That is the sum and substance of a joint development agreement. Now, after that, the landowner may be receiving a portion of the completed real estate property instead of from sale to customers. So then it is not a real estate development agreement from the point of view of the customer. So who is the here? So then that contract will have to be split into two parts. For the real estate developer, he has in any case paid to the landowner. So that is as part of the land cost. He will make his sell to the customers, correct? So that will also be accounted for as a real estate development project, which will include the cost of the land which he has acquired from the landowner. He may sell a completed real estate property. Now that completed real estate property which he sells to the landowner, that landowner is not his customer. So that is a contract which is not within the scope of the revenue recognition standard. Are we clear on this? This is important. The landowner, so there basically he would be selling it, but that would be like other income, or the fair value of the consideration which he sells. Basically, it is basically like a cost to him to some extent, because whatever he is developing, he is giving it to him as a consideration for the cost. He may not even necessarily then have to pay for the land. So it all depends upon what the arrangement is. But it is, in short, that part, completed real estate property which the landowner receives is not considered as a sale by the developer to the landowner. It is a contract which is, it is a joint arrangement which is there. You will have to maybe account for that separately. It is maybe a non-cash transaction also which may be there. It may not even be accounted. Or whatever cost which he is incurring, that could be considered as part of the cost of development. The portion of the cost attributable to the flats or the real estate which is given to the landowner. So there could be various scenarios which may be there, but the fact is that it is not a sale. Clear? This is important. Now here another important scheme. A real estate developer enters into a contract with a customer for sale of flat in a building on the 10/90 scheme. 10% paid on booking, 90% paid on delivery. Now this is specifically, I am examining this under Ind-AS. I am not examining this under Indian GAAP. Indian GAAP, it is these arrangements are permissible. 10% if it is paid on booking and all that, it may still meet the threshold. If the other conditions like approvals and all that are satisfied, he may book revenue on the POCM. Here, whether it is a contract with a customer, first, the contract is non-cancelable. However, as per regulations, irrespective of the contract, the customer can back out of the deal and not take delivery. So here under Ind-AS, this is also an important criteria, that can a customer back out of the deal and not take delivery. So then in that case, the deposit will be forfeited. So now what happens? Is this a contract with a customer or not in this under the 10/90 scheme? It is first of all not an enforceable contract. It is very clear. So that is where the deposit amount remains as a liability till the contract is explicitly enforceable. And the deposit will be recorded as revenue when the customer does not take delivery and the amount is not refundable. So only in a situation where the customer does not take delivery and the contract is not enforceable and then the deposit gets forfeited, at that point of time, the deposit becomes revenue. Otherwise, till that time, there is no contract with the customer. He has just got a booking amount. So this is an important consideration under Ind-AS. Under Indian GAAP, of course, in this situation also, you may have to see that if the contract is not enforceable, whether the risks and rewards are passed or not. Because a booking amount may be paid and the risks and rewards may pass, so a customer may back out separately. So at that point of time, when he backs out, whatever revenue may have been recognized under the POCM would then have to be reversed as we saw. So here the revenue recognition principles are totally different than that is 1090 scheme. So this is an important difference which is there. Because here there is no contract with a customer. He does not become your customer because there is no enforceable contract. Just paying a booking amount does not make an enforceable contract because the customer can back out at any time. And once he backs out, only then at that point of time, he can the developer can book the deposit amount. Or when an enforceable contract is entered into, that then will have to be seen as to what are the performance obligations of that enforceable contract, which we will see later. Then performance obligation. What are the general second criteria? Identify the separate performance obligation. These are the general principles again. Good or service which is distinct. So essentially a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. So it is like a project, maybe a separate performance obligation in simple terms, what we have identified as a project. Now within the project, there may be separate performance obligations for a club or swimming pool. Whereas a common road which you construct or develop may not be a separate performance obligation because that on its own, it doesn't have any relevance. Some of that could be explicitly stated and some of them may be implied by performance, implied by past performance, implied by expectations, valid expectations are created, what we typically refer to as constructive obligations. See, certain cases you may be constructing in an underdeveloped area. So there providing the common amenities, infrastructure and all that is implied because the customer cannot avail of these benefits separately. Whereas if it is in a developed place, it could be a separate performance obligation. So that is what you need to see. What is separate, what is combined. Activities which are purely administrative nature. See, they may be providing certain services to basically get your agreement signed, stamp duty to be paid, documentation requirements to be implied, for which the developer may be charging certain fees to the customers. These fees which are charged are not part of your performance obligation. These are purely administrative support, administrative nature duties which are provided. So you cannot this is a distinct other income for him. This is not in the capacity as a customer. He is just providing administrative support. He may or may not even take a margin. It may be reimbursement of actual costs. He may take a certain margin also. Those are separate services which are administrative, purely administrative in nature. Very clear. So some other charges which he may also recover may be purely for administrative services. These may not even be construed as revenue from contracts with customers. That may be in the nature of other income. Again, this is a thing which is not entirely always implemented. So distinction between operating income and other income is important. And this is purely other income. Especially if this is a reimbursement of expenses and there is a top-up margin which is there. So now here see some practical considerations. The individual houses are part of a larger new development. Then there are amenities such as street lights, bus stops, gardens and recreational facilities provided by the developers. So this could be one sort of an arrangement. There are individual row houses or individual flats, but there are amenities provided within the complex of street lights, certain bus stops, gardens, recreational facilities. Then there may be amenities such as clubhouses, swimming pools, gymnasium and health club. They are transferred in connection with the sale of individual units. See, there is a clear understanding that if you have a particular flat, if you book or a particular row house, you are entitled to the membership of a clubhouse, swimming pool, gymnasium. So it is connected and attributable to the sale of individual units. Or there may be situations where specific customer requirements such as extra furniture, fittings, white goods, flooring, etc., which are specific to an individual customer are there. So then what are the factors which you need to consider whether they are separate performance obligations, whether they are distinct in the context of the contract, whether this clubhouse, swimming pool, gymnasium and all, whether they are distinct. Then who provides these facilities? Sometimes once a building is completed, the clubhouse, swimming pool and all those may be developed and the residential society may then be in charge. So then it is a separate performance obligation. The parties to whom promises are made, it may be to outsiders also, maybe members, or it may be to the flat owners. And if the real estate units cannot be sold without the promise of amenities because the location is very remote, the unit and the amenities can be one performance obligation. Because otherwise, without that, without the amenities, the unit is not habitable. If the unit is a more developed area and the customer can separately arrange for the necessary amenities like roads and all that, then those roads facilities can be separate performance obligations. So again, a lot of judgment. So if it is something which is separately, if he can avail, or it is something which it has to be provided by the developer, and without that, the sale of the particular unit is not really likely to be of any benefit. It is not likely to provide the intended benefit or controls to the customer. So that is what is the criteria satisfying the performance obligation. So these are all important things. So you're now in the context of what we saw as a project. Here also you need to look at it in the context of a project, but whether here now you're not from the POCF perspective, but whether what is a performance obligation or not. Whether how many, whether it is a common performance obligation or whether it is a specific performance obligation. So the evaluation criteria changes, the ball game changes entirely in the evaluation under Ind-AS. You take another scenario. A contractor enters into a contract to design and build a house for a new homeowner. Separate, he is building a bungalow. Say somebody like an Ambani or any Ratan Tata or any big industrialist, he is building a nice bungalow for them. The contractor is responsible for the overall management of the project and identifies the various goods and services which are provided. He provides the architectural design, site preparation, plumbing, electrical, carpentry, everything. Full package contract. The contractor also, see this particular contractor or developer, he also individually provides the services also to the customers. So now how many performance obligations are there? This is again a typical scenario. See here also, whilst the customer can benefit from the various services, they are not distinct in the context of the contract. They are part of one package. See, because the contractor, I mean the homeowner, he cannot occupy without the plumbing being done or without the electrical work being done or without the carpentry being done. The house will be of no use to him. It will not provide the intended benefits. So the contractor provides the significant service of integrating. These services significantly modify or customize each other. They are all customized. The customer has given a combined consolidated contract to the home builder to build a house. Correct? For which he is providing the various inputs like your plumbing, carpentry, electrical work, whatever, construction services apart from the construction. So all this is all part of one. Tomorrow, subsequently, once he has completed and given him the house, possession of the house, if after 2 years there is a leakage in the bathroom, that plumbing service which he provides is a separate thing. But just because he provides those plumbing services separately doesn't mean that even at the initial state, this plumbing or electrical work is a separate performance obligation. Has to be all together. So he cannot say that I will only book the revenue from the construction of the house and then book revenue thereof. And then when the plumbing, electrical and all that is completed, I will book it. So here If it is a single row house or a single plot which is there is no question of a POCM coming into the picture. Whereas under Indian GAAP, he could have applied the POCM. So it all depends. Then here again a situation peculiar under Indian GAAP. Sale of land along with a residential unit. A developer is developing homogeneous units and sells either individual homes constructed on a plot of land, or he is just selling the undeveloped plots along with accompanying services. So here he is homogeneous units constructed on a plot of land. So that is an undivided share of land, or he is just selling the undeveloped plots. And then he also provides accompanying services like electricity, water, and all that to the individual customers. So whether the sale is of land is a separate performance obligation depends upon the facts and circumstances. Here, if the land cannot be sold without the promise of accompanying services, again, because the location is remote, this is important criteria. It could be considered as a single performance obligation. Whereas if the land is in a more developed area and the purchaser or customer can separately arrange, then the sale of land is a separate performance obligation. Here there is no construction involved. So that's the sale of land, and then the customer can individually avail of the other facilities or services. He may even contract with the same real estate developer, he may contract with another real estate developer, he may other services. So if the developer sells fully developed plot with a house, it would be a single performance obligation. That is again another criteria. Only one fully developed plot with a house, it would be a single, only once the completed house in a certain setting. So it is a single performance. Your plumbing, electrical, carpentry, and so on and so forth are all not separate performance obligations. Now here look at the situation again. When the building has multiple floors, the contractor will normally transfer the underlying land to the cooperative society, which is what happens on completion, and the customer receives the completed residential unit. Accordingly, the land and building are not separate. So even here also, though there may be multiple flats, the land underlying will be transferred to the cooperative society on completion, and he receives the completed residential unit with the undivided share of the land. So again, here there is no separate performance obligation. So separate performance obligation is something akin to identifying what is a project and not, and then whether individual units or not, whether it is a combined project or not a combined project. And when is the performance obligation satisfied? That will come to later once we have first identified what is a performance obligation. Then determining the transaction price is the next part. Now, what is the transaction price? It is the amount of the consideration which an entity expects to be entitled to in exchange for promised goods or services, excluding amounts collected on behalf of third parties. May include fixed amount or variable amount. See, the consideration now, an important criteria under Ind-AS is a variable consideration. Consideration which may vary based on the performance. So it may be an expected value method or the most likely method. There may sometimes also be a significant financing component in real estate. We will see that part also. So financing component you need to separate out and show as part of finance income, other income. So here basically apart from a fixed amount, there may many be cases where there may be a variable consideration which may be there. So let us take an example of how you may measure a variable consideration, or which situation or which circumstances you may end up having a variable consideration. Let us see that with the help of an example. The A Limited here is a real estate developer. He enters into a sale agreement for a newly constructed shopping mall with a retailer, with a customer for 20 crores. So that is, he just develops the real estate. A lump sum consideration of 20 crores is paid. Plus there is a right to receive 5% of the revenue for the first year. There are no other performance obligations. First year, he has a right to receive 5% of the revenue. Now here, he has to make an estimate upfront. Revenue transaction price includes a variable element. He has to estimate what the 5% revenue would be. 5% of the profit would be. So now, here basically, you have the future revenue, 10% probability. Sorry, instead of future profit, please leave this as future revenue instead of profit. So 10% probability that the future revenue would be 50 crores, 35 crores or 10 crores within the first year. So there is a probability. So based on this probability weighted outcome, we saw that you determine either on the basis of an expected value method, which is nothing but a probability weighted outcome, or most likely method. These are the broad principles which are laid down in the standard. So you're using the probability weighted outcome and assuming that, see, one of the criteria for variable consideration is that you should book the variable consideration provided it is reasonably certain and there is no significant likelihood of its reversal in the subsequent period. But the important thing is you have to book it and identify it upfront. So here the variable consideration works out to 1.575 crores. If you look at the calculation, 10% of 50 crores, 70% of 35 crores and 20% of 10 crores, that is the total. So the total consideration is 20 crores plus 1.575 crores. Then subsequent period, if the revenue recognition, if the percentage changes, your variable consideration may also change in the subsequent accounting period. But there should be no reversal. There should be no large reversal. So this is the third criteria, determining the transaction price. Now the transaction price has to be allocated to the performance obligation. We have seen the performance obligations, whether single or multiple and all that. You have to allocate these. Sorry, prior to that, we need to look at the transaction price for financing component. Now here, when does a financing component exist? See here, there may be a situation where the consideration does not match the expected goods transfer. See, this is typically the case in this 1090 or 2080 schemes and all that which we saw. Bulk of the amount comes from the customer only at the end of the period, 90%. Whereas you are incurring the costs and even transferring the goods and all that on an ongoing basis. So in such cases, the time value of money needs to be adjusted. However, if the gap is expected to be 1 year or less, then you may ignore the financing component on grounds of materiality. Then another important thing is there may be a penalty clause also which will be there. So sometimes even the penalty clause also has to be adjusted upfront if it is inherent in the determination of the transaction price. So not only variable consideration plus your financing component plus the penalty, these are the three things which are there. Real estate contracts normally include a penalty cost for delayed construction, requiring the entity to compensate in the form of interest on delayed construction. So any penalty which is paid to that extent, that has to be adjusted against the ultimate selling price. Very important. We may not be doing it under Indian GAAP, but under Ind-AS we need to do it. Because that is a variable component of the transaction price. It is something which is inherent in the contract. See here there are some practical considerations. If a huge installment received upfront, this is important. You may receive a huge installment. 80% of the installment you may receive upfront because the developer has incurred significant land costs to compensate for the land costs. That there will be no financing component. You are not doing any financing. Rather, that fellow is doing financing for you. This is financing where you are doing, not the other fellow. Here, the other fellow is like giving you a loan. He's giving you a money upfront. Generally, a sufficient payment received at the end of the project represents a financing component subject to there being an enforceable contract. Many times you may take the money in line with the stage of completion. So in that particular case, you need a careful evaluation to determine whether there is a financing component or not. So all these are some of the practical considerations which you have to do. The allocation of transaction price to the performance obligations. Now, how do you? We have seen the various performance obligations: land, combined, swimming pool, clubhouse, roads, developed area, non-developed area, and so on. Now, sometimes if we have identified that something is a separate performance obligation, there may not be separate pricing available. So you need to determine and allocate the transaction price to the performance obligation. So adjusted market assessment approach. What are the separate prices which the competitors are charging? So that is what would be one of the criteria. Cost plus margin. What is the normal cost plus margin? Or a residual approach, total transaction price less sum of observable selling prices. Observable selling prices means observable prices if an independent arm's length transaction were to take place in the markets. So these are all the bases on which you will have to allocate. So this is more of an allocation which is done. So this to some extent is again similar to what is there under our Indian GAAP. They said fair value or any other reasonable approach. So here, even for our Indian GAAP purposes, you can take the guidance from Ind-AS and allocate within a project the performance obligations and all that. Now the final point. This is now the final point which is there. Performance obligations whether satisfied over time or point of time. Now this is where practically the most challenges will apply. Real estate companies will find it very difficult to apply the POCM method because of the application of the control model. So the control model, it requires you to determine at the inception of the contract whether the entity will transfer control over time or at a point of time. The assessment of whether revenue recognized over time requires the consideration of the rights and obligations created under the contract and the legal environment in which. This is what is clarified by ICAI via its press release. Basically, as I said, you need to see whether the obligations are satisfied over time or not. It is based on the legal environment within which the contract is enforceable. So the ICAI has given a leeway that you can consider in certain situations that the performance obligations are satisfied over time rather than at a point of time. Because otherwise the control model in the normal course, it is presumed that the real estate development only when the flat is handed over and the customer is able to enjoy the benefits of the flat, that the control is transferred. So revenue has to be recognized only at a point of time. But no, there could be certain situations, and howsoever limited they may be, most of the criteria will be at a point of time, but there would be still 10, 15, 20% of the cases if proper structuring is done, you can still recognize revenue at a point of time. How we need to do it, we will see with the help of certain practical considerations or how you can actually do the structuring. First of all, let us just see the overriding principles of criteria for overtime revenue recognition. This is what are the principles laid down in Ind-AS 115. The customer simultaneously receives and consumes the benefits provided by the entity as it performs. So that is clear. Simultaneously, whatever work has been done, whatever construction, development, WIP and all is done, the customer simultaneously receives the benefits. See, practically this looks a little difficult, but how that can be ensured, we will see. Because in a real estate, you cannot see that if the first slab is constructed, it is of no benefit to the customer individually. But in certain situations, the legally enforceable rights and all, if they are there, you can still satisfy the criteria over time. The entity's performance creates or enhances an asset that the customer controls. Whatever is the WIP which is there, whatever is the construction cost which is getting built up under WIP, the customer controls the asset. And the entity's performance, this last point is important in the context of real estate recognition over time. The entity's performance does not create an asset with an alternative use. And the entity has an enforceable right to payment for the performance completed. So even if it is part performance, the entity, the real estate developer, has a right to the enforceable right to the performance obligation for the performance created till date, performance completed till date. So these are the general criteria which have to be satisfied. And the third criteria, second and third criteria, are more important in the context of real estate development to see whether we can recognize revenue over time versus a point of time. So now let us see the facts of a case. Now here there is an entity which is developing a multi-unit residential complex. The customer enters into a binding sale contract with the entity for a specific unit which is under construction. There is a multiple unit, right? 20, 50, 100 units. I am an individual customer. I enter into a binding sale contract with the entity for a specific unit. It may be a specific flat within a building. It may be a specific row house within a complex. Now, each of it is all under construction, mind you. Each unit has a similar floor plan, but other attributes are separate. Then what does the customer do? Customer pays a non-refundable deposit on entering into the contract, and he will make progress payments during the construction of the unit. Clear? He pays a non-refundable deposit, and he will make progress payments during the construction of the unit. The contract prohibits or prevents the entity from being able to direct the unit to another customer. I, as an entity, real estate developer, cannot direct the unit to another customer. The customer also does not have a right to terminate the contract until the entity fails to perform its promises. Correct? If the customer defaults in making the promised payments, the entity would have a right to all the consideration promised in the contract till it completes the construction. So entity has a right to enforce that you have to pay me for whatever work has been done or whatever amount you are supposed to pay till the third slab stage of the construction, for example, till the particular milestone. And these rights are upheld by courts. So this is one typical situation which is there in many contracts, and this is how companies will try to now structure the documentation for their real estate contract. So now here, let us evaluate all this. I hope the facts of the case are very clear. The entity concludes that the asset created by the entity's performance does not have an alternative use. That is very clear. Since the contract precludes transfer to another customer. So that is one of the criteria. The entity has a right to payment for the performance obligation completed to date in terms of the contract, and the legal practice is prevalent. Here you are assuming on a going concern basis that the contract will not be terminated. So assessment of the termination of the contract is not important. So here you can take basically revenue over a period of time. And there basically you use the input method, which is nothing but your PUCM method based on the cost incurred to date to the total estimated cost. So in such situations, you may be in a position to recognize revenue over a period of time. I'm not saying under the PUCM method, but recognize revenue over time with the individual customers, the contracts which you enter into with them. Clear? So here 2 or 3 things are important. The asset does not have an alternative use. Customer cannot easily back out. And the entity also cannot back out. Only there is a remote possibility only of a contract being terminated. Customer does not have the right to terminate the contract only if an entity fails to perform its promises. Suppose the builder goes bankrupt, developer goes bankrupt, or developer stops the construction altogether for 6 months, 1 year, 2 years, then it's a different thing. So then the legal criteria will come into the picture. Otherwise, no. Now here you take so this is the first case. There are very tight conditions which are laid down. Whether all real estate contracts actually have this condition is not very sure, not very clear. So you need to structure it in a watertight way appropriately to enable you to meet the overtime recognition criteria. Otherwise, by default, normally it is at the point of time. So here now you take a situation where basically at a point of time, the entity is developing again a multi-unit residential complex, same criteria as earlier, binding sale contract for a unit which is under construction. Now here, see, this is important. The customer makes milestone payments as per the contract, which are cumulatively less than the work completed to date plus the normal margin. So what the customer pays you is not commensurate with the work which the developer is completing. And a significant portion of the contract price is paid by the customer on delivery. If that is the criteria, then the evaluation changes. So it is very important how the contract is structured. Milestone payments are significantly less as per the contract completed work plus the normal profit margin. Majority of the thing is on delivery. So that means the performance obligation for the customer also is mainly towards the end. In case the customer wishes to terminate the contract, either party can identify a new buyer who will pay the remaining amount. Customer can move out. New customer may or may not compensate the original buyer, that is different. Contract is silent even when a new buyer cannot be identified. The entity cannot enforce claim for remaining payments. A customer can move out anytime, new customer may or may not come, entity cannot enforce payments. So here it is very clear, common sense. The entity does not have a right to payment for performance completed. First of all, the payments which are made are not payments which are made to the entity by the customer are not commensurate with the performance. Until the construction of the entity is completed or the entity has the right to the milestone payments, they do not compensate for the performance to date plus the payment margin. Whether a new customer comes or not is not directly relevant. So here this is very clear. So this is, there are most of the cases, contracts are over period of time or point of time, you need to structure it appropriately. These are just some general guidelines or criteria. And the press note has clarified that as long as the performance criteria satisfied over period of time, the principles which are laid down in the standard which we saw, this is important. The entity's performance creates or as an asset is created. So he pays it as and when the work progresses. There is no alternative use. But however, if the customer moves out, then there is an alternative use. Now we come to the last part of the standard, or second last part other than disclosures, of course. There is a concept of contract costs. Costs of obtaining a contract and costs of fulfilling a contract. There are 2 types of contract costs which are identified in this standard. This is an entirely new addition. There is no corresponding cost concept under the revenue recognition standard AS 9 under Indian GAAP. It doesn't talk about any costs related to the revenue. Cost of goods sold is what we normally say. This is contract costs. It is typically what you say cost of goods sold. Only thing is now we have costs of obtaining a contract. See, costs of obtaining a contract are those incremental costs that an entity incurs to obtain a contract which otherwise it would have not normally incurred. Basically, typically any business development or selling costs which are there, which it has to incur, or similarly any other similar costs which are there. In the real estate context, these are typically sales commission to real estate brokers. These are typically the costs of obtaining a contract. To have two parts, mind you. They need to be recognized as an asset, means typically what we refer to as a prepaid expense. There is contract costs are nothing but prepaid expenses, which the entity expects to recover, and then they are, unless they are within, not in the scope of another standard. See, there may be certain specific costs which may be prohibited to be capitalized. That is a different thing. So you expense off as a practical expedition if the amortization is less than 1 year. If the real estate development project takes less than 1 year, then there is no headache. Only thing is, if the project is more than 1 year, more than 12 months, then you amortize it over the estimated period taken to complete the contract, to complete the particular real estate development project. So typically in real estate, you have the sales commission. See, generally now sales commission is based on a specific percentage of the sales value. Brokerage is fully paid on execution of the agreement, which may be partly or fully refundable if the agreement is not fulfilled. This could be another one arrangement. Brokerage may be paid proportionately as and when the amounts are received from the customer. That is a separate arrangement. Or brokerage may be paid on receipt of the full amount from the customer. So there may be various arrangements based on which the brokerage may be paid. So you need to accrue the brokerage expense. All such brokerage costs you need to amortize on a basis which is consistent with the entity's transfer of related goods or services, means essentially over the period of your real estate development. So typically this is a major gap difference. It is a very important concession which real estate companies are given. Earlier, all these real estate companies, in fact, under Indian GAAP, even now, the sales commission has to be charged off. Any sales, business development, marketing expenses and all that. Then second is costs to fulfill a contract. Costs to fulfill a contract are our normal project costs in simple terms. What we discussed as project costs in the context of real estate, these are the specifically identifiable costs directly related to a real estate development contract. They are useful in satisfying the performance obligation and they are all recovered. Normally, all these costs are recovered plus a margin and all that. So they need to be recognized as an asset. So in any way under real estate development, we recognize these as WIP and we carry it forward, right? So there is no, but the important thing is that for even other contracts, other than real estate also now, you can identify separate such costs, especially other service providers can identify. Real estate development, this is nothing but your project costs and all that in very simple terms. So there is no additional complication which is there. So your examples in scope in the context of real estate is direct material and labor, allocated direct costs like insurance, depreciation, all those other examples of project costs which we saw. Any cost explicitly chargeable to a customer under a contract and all that if they are there. So these are all general administrative costs. Wastage is never loaded onto inventory, so wastage is excluded. Costs related to specified performance obligations. When we say costs related to specified performance obligations, those are separate things which are there. Separate services, administrative services and all that, those are separate. So those are not costs to fulfill a contract. Like how we saw, the services which you may provide. So those are administrative, purely administrative in nature. So clear? So these are, as far as real estate, it is much simpler. Cost to fulfill a contract is mainly what you typically would categorized under your project costs, and the others would be typically your selling expenses primarily in the context of real estate costs to obtain a contract. Now we come to the last part again of disclosures. Revenue recognized from contract is in. This second point is an important deviation. Reconciliation of revenue recognized with the contract price. See, you have a contract price as per the agreement that 100 rupees is the sale price. You may give some discount. There may be a penalty which you may charge. There may be some variable consideration which may be there. There may be some discounts or rebates. All those have to be excluded in the transaction price. So revenue recognized, contracted price 100 less discount, rebate and all that minus, and that is the transaction price. You need to disaggregate the revenue consistently with the segment disclosures. Now in real estate context, it may be by geographical region, by type of customers, duration of contracts, timing of transfer of goods or services. So where the projects are, type of customers, government contracts, residential, commercial, duration of contracts, 1 to 2 years, 2 to 5 years, and so on. It depends upon what sort of MIS, because there are segment criteria laid down under Ind-AS 108, how your chief operating decision maker reviews your performance. So that revenue has to be also disaggregated in line with your segment disclosures. So typical disaggregation from real estate may be based on these criteria. Mostly geographical region or type of customer, duration and all that is not normally a criteria. Timing of transfer of goods or services. See, infrastructure company may have basically come contracts now for the construction of metro. Then there may be certain other general construction contracts. So those are all by types of customers. Disclosure of contract balances, essentially only thing is your prepaid expenses and any other amortized assets, plus your WIP and all those other things also. Performance obligations, including the timing of satisfaction of performance obligations. That is important. That is an important additional disclosure you need to give. Earlier, you used to say what is the point of time when your risks and rewards are satisfied. Here, what is the point of time when performance obligations? And in real estate, it becomes very important, especially if you adopt a overtime performance obligation recognition. Then you need to give the disclosure. That is very important. Significant judgments which you may be making in how to allocate the transaction price among performance obligations, how to separate the various performance obligations if there are common services, what are the judgments which you use and all that. So all those are the qualitative disclosures which you will need to give. You may use some practical experience in financing costs, less than 12 months amortization, or if it is immaterial, you may not necessarily amortize. So these are all the practical exceptions or practical experience which are there. So now finally to summarize, and after all, Indian GAAP and Ind-AS control versus risks and rewards, very important. POCM versus performance obligations, timing of revenue recognition changes, substance versus form, and the treatment of commission and brokerage. So these are finally the main differences which are there. So quite a lot of companies, there are mixed practices in real estate development companies under Ind-AS. Most of them recognize revenue at a point of time. Some of them may recognize revenue over a period of time. Commission and brokerage treatment, that is a major balance which comes in selling expenses. Those who incur huge commission, those they can, instead of being charged off earlier, they can now amortize them and carry it forward as a prepaid cost. Performance obligations, POCM and all criteria. Performance obligations is more judgmental and substance driven. POCM is a combination of substance and form, qualitative as well as quantitative. So that would impact the timing of your revenue recognition to a great extent. So with that, friends, this is all I think in the journey of real estate. I've tried to make as much of a real impact as I could And I don't know whether I have satisfied all my performance obligations. That is for you to judge. But I have tried my best, given the time constraint, and tried to make it as practical and as relevant as possible. At the same time, to balance the considerations of both the large practitioners who may be there and also the small and medium-sized practitioners. You would also have to, of course, see this in the context of the taxation requirements, which you would have studied, in the context of the legal requirements, in the context of RERA and all that, which I'm sure all of you would have covered over the course of the past few weeks. So with that, I would be happy to take a few more questions on the Ind-AS part and also some of it on the first part also. Thank you very much once again. May God bless you all, and hope all of you are stay safe and healthy. And we are out of this pandemic in a short period of time now. Things are, of course, improving and hopefully will continue to improve. Thank you very much.
Thank you, sir. Over to Manas for the
Yes, sir. Sir, the questions, I think we have a very few questions, but I'll just take them up.
Yes, please.
Sir, this question is from Pareshji only, that what is the unbilled revenue line item that appears on the asset side of the balance sheet of a company in the real estate business?
Unbilled revenue does not appear on the asset side. Unbilled revenue appears on the liability side. Unbilled revenue is on the asset side. No, it can't be on the assets. Unbilled revenue is basically where you have received money in advance. Unbilled revenue is advance payments which you have received is unbilled revenue.
And so the next question is from Abhirup, that payment of assured returns by builders to flat owners will be considered as expenses in the books and not a part of the project cost. Whether his thought is correct or not, sir.
Sorry. Can you come back?
Payment of assured returns by builders to flat owners will be considered as an expense in the book and it will not form the part of the project cost.
This is not part of project cost.
It's not the part of the project.
No, yes. Hello, Hinesh bhai, nice to see you.
Yeah, thank you.
Hello, nice to see you. I was wondering if you also okay.
No, I was there. I listened to the entire presentation. Only the previous, I think, queries. If you can unmute him, his question can be properly answered about that unbilled revenue thing.
Right.
Is it possible, Manasji, to...
Yes, sir.
Can you unmute that querist so that he can clarify to sir?
Yes, sir. Yes, sir. I can unmute the query, sir. I can unmute the query. So as we have very few questions, so we have decided that the querists can ask their questions directly from Zubin, sir.
Okay.
I'm unmuting Paresh Bagrecha ji. Paresh, sir, I have allowed you to talk. You can please unmute yourself and ask your question, sir.
Good evening, sir. Can you hear me?
Yes, please. Yes, please.
Sir,
go ahead.
Sir, I was just going through annual report of Parshona Developers.
Correct.
And I have seen in many balance sheets of real estate companies,
Yes.
one item, unbilled receivables or unbilled revenue.
See,
Invariably,
unbilled receivables is basically where some amount is due after a particular date. The revenue, the performance obligation may have been satisfied, but
okay.
A due date as per the contract may be at a later date. So that is what is basically receivable. It is not debtors, mind you.
Okay. I got it. But then how do you work out that amount?
No, see here, if you take that particular example, which I said that typically, see, you have to receive as and when the work progresses.
Okay.
So here you may keep on receiving the amount as and when the work progresses. You may also be entitled to book the revenue based on that criteria as and when the work gets completed, and you may receive, I mean, as per the contract, you are entitled to receive a particular amount which is much higher, but you cannot book revenue because the performance obligation is not completed. It is, I mean, in fact, you have not received the revenue, as per whatever is there as per the contract, as per the milestone. So that is receivable.
But then an unbilled receivable account is debited. That means some amount is credited to some another account. Then which is that account
to be credited to revenue?
Okay.
It will be credited to, unless see there may be, has Persona developers also shown anything as trade receivables or contract assets?
I could not.
Because I'll tell you one thing, there are a lot of companies who even mix up basically unbilled revenue with work in progress. In fact, today only in the morning, I was with a particular infrastructure development company in Andheri. I had gone, where basically they have actually treated everything which should be as WIP for all this metro work and all which they are doing as unbilled revenue.
No, this company has shown in work in progress separately in its balance sheet.
No, so has it shown sundry debtors separately?
Yeah, trade receivables have also been shown separately.
Trade receivables have also been shown separately. Then I think unbilled revenue receivable looks a little illogical according to me.
Sir, there might be cases wherein, sorry to interrupt you, sir, there might be cases that because Paswana is a big builder and they would have, out of their, whatever they are preparing their POCM sheet or A7 sheet, so from there it might happen that they might not have billed for any particular project, but they have incurred expenses, so they have recognized revenue out of that.
No, but that is, you are assuming that the performance obligations are satisfied over a period of time. That criteria, if they are meeting,
yes,
so
sir.
that is what I said. If they are meeting the criteria and over a period of time, they could have billed as to the customer.
Yes, sir. So they have not received
receivable
advance
as per the contract.
Yes, sir. Yes,
receivable as per the milestones, but maybe the invoicing may have been delayed. Possible.
Yes, sir. Yes, sir. Yes, sir.
And it may have been also possible that maybe because of the lockdown related thing also. Is it only this year or is it earlier periods also?
Every year, sir. And Persona is not the only real estate company.
There are others also who may be there.
Yeah, yeah.
Sir, because we came across certain when I was doing certain audits.
I think that corresponding credit will definitely go to revenue only, so that is not a problem.
Yes, sir. Yes, sir.
Okay. Okay. Thank you, sir. Thank you so much.
But there are many companies who also mix up unbilled revenue, work in progress, and all that also. I think I have seen just now only today morning only I was dealing with one such case.
So next is Mr. Nitin Furia ji.
Yes.
I'm just unmuting Mr. Nitin Furia, sir.
Yes.
Nitin sir, I have allowed you to talk. You can raise your question, sir.
Yeah. See, we are fulfilling all the criteria for offering the income, turnover percentage, work completion, amount received, etc. All criteria fulfilled.
Under Indian GAAP, you are talking,
yes,
right?
Yes.
Yes, yes.
Now the question is, if whether I want to declare the profit on ad hoc basis, say 6% or 8% or 10% based on specified working, there will be, but instead of getting exact amount, can I declare the ad hoc percentage which will be nearby the working?
No, why ad hoc? There is no question of ad hoc here. You have to basically book your percentage of completion, but ultimately it has to be on whatever is the total amount which is receivable. The question of any ad hoc profit percentage does not come into the picture.
Because I'm in the initial stages, say around 25% work completion, etc.
Even if 25% of the work is completed, there will still be, I mean, you cannot take an ad hoc percentage.
So, but if I want to declare on ad hoc basis,
have to recognize
I will declare higher side also, or lower side, whatever may be the possibility.
I don't think you can get into a ad hoc profit criteria. I don't think that is really something which is, at least I would not recommend that alternative. See, because ultimately it has to be on the basis of the actual. You may work out basically your total estimated revenue and you have worked out your total estimated cost, right?
That's
And then
correct.
based on the total estimated cost, you have arrived at what is the percentage completion.
That's correct.
So the revenue to in any case you will be recognizing based on whatever amounts which you are entitled to receive, right?
Yeah, but that this is in fact is estimation. So that estimation is also on ad hoc basis.
No. So estimation. So you will have to you will have to determine that upfront.
Yeah. See, the cost of project is also estimation.
No. So total revenue and total cost. So you know what is the profit margin which is there.
Right.
So
That's
to that extent, you will have to know what is the total revenue and the percentage of the total revenue you have to book. There is no question.
fine.
If
Thank
you have estimated that your total estimated project revenue is 100, your total estimated project cost is 80. So your profit is 20 rupees, right?
That's correct.
Now you have actually incurred, say, 25 rupees worth of costs incurred.
Yeah.
You have how much is the percentage? 25 as a percentage of 80 is more than 20, some 30, 35%, whatever. So you will have to book revenue to the extent of 35% of 100 rupees.
Yes, that's correct.
So that is there, which is there. So there is no question of taking an ad hoc profit.
No, on that I estimate 20% profit was based on the working. So
it
that
automatically comes because you have already booked the cost. So you are only booking a revenue. So profit will automatically come in. There is no question of booking a profit.
Okay.
The fact that when you book your revenue at the percentage, what is there at the percentage completion, that itself takes care. So there is no question of adoption of any ad hoc profit and all that, according to me.
Okay, thank you.
You may change the estimate of your revenue and you may change the estimate of your cost, but that then gets adjusted in that particular period as a change in an estimate, change in an accounting estimate.
Right. Okay. Thank you.
Sir, we have just now we have some questions from Abhirup, but I think he is not available right now. So I'm just taking one last question on his behalf.
Yes, please.
That in the JDA, how to determine % of work completed for the developer? Whether construction cost.
Principle. See, JDA, as far as the real estate developer is concerned, for him it is like a same real estate project. See, because the cost of, unless there is an arrangement where he also has to share the cost with the developer is also sharing the cost. So if the developer, if the real estate owner is also sharing the cost, then it becomes a joint arrangement and it is not a real estate development contract. Then it is like some unincorporated arrangement which is there.
So with that, we are the questions are done have been answered by you, sir.
Yes.
I think the doubts of the participants have been
I
clarified.
hope so. Yes, I hope so.
Nilesh, sir.
Yeah.
So I think Deepak sir is there. Deepak sir?
No, Deepak sir is not there.
Deepak sir.
So, Hinesh bhai, you wanted to say something?
Sir, I think he's on another call, sir.
No, Hinesh bhai is there. He is. So, tomorrow voice both demo આવે છે.
Can you hear me?
Yes, sir. This is better. Yeah.
Can you hear me?
Yes, yes.
Okay. Zubin bhai. Can you hear me, Zubin bhai?
Yes, Hinesh bhai.
Yeah. So I think that question regarding contract revenue.
Yes.
There could be a situation where I have not achieved my milestone.
Yes.
But I am booking the method of cost of project or cost incurred basis to book my revenue.
Yes.
In that case, I may not have a trade receivable, but I may still have a unbilled.
नहीं भाई आपकी आवाज नहीं आ रही है.
Yeah. No, but this is under Indian GAAP or under Ind-AS?
Basically, that is this probably one reason I am just thinking.
No, but this under Ind-AS it may be difficult.
Okay.
Under Indian GAAP you can have that situation.
Okay, got it.
under, because now the listed companies, Parswanat and all will be under Ind-AS. So there it may be, first of all, it has to satisfy the overtime criteria. So there I think it may be a little bit challenging. I don't know whether the accounting is entirely done correctly. I think probably my feeling is that many companies are still applying the percentage of completion method criteria under Indian GAAP incorrectly. That is what is my feeling. I think this will, real estate accounting, I think under Ind-AS will need a lot of churning. I am telling this based on an actual live example today morning when I had visited a customer, coincidentally, an infrastructure developer, which was a listed company. So there were a lot of gaps and errors. I think there will be major restatement also, which may be probably required next year, if they really follow the correct protocol. So people are mixing up. See, people have still not got out of that POCM mindset. They are still continuing to apply the guidance note in that with the calculations and all that. This, strictly speaking, they should not under Ind-AS.
So what is practically happening is Indian Income Tax Act will say that Income Tax Act says that you offer on a percentage basis. So suppose 8% is offered.
Income tax and all that is okay. I mean, ultimately, then you have to adjust it to deferred tax.
Okay.
The people here, the mindset is, as I always say in every forum, tax is a professional obsession. I'm sorry to say that. I think tax does not drive accounting. Accounting is independent. Now, under accounting also, you have got the criteria and the concept of a deferred tax now to take care of the difference in the basis between the accounting and the tax. But people, unfortunately, still, I think, try to be driven by the tax many times.
Right.
That is where they goof up on the accounting and sometimes get into trouble at both places.
Okay.
Nilesh bhai, in my experience, you have to actually maintain two sets as far as POC accounting is concerned.
Yes,
right?
have to. Yes, I agree. I mean, has to be separate, and that is where the deferred tax adjustment then comes into the picture.
And also ICDS
Yes.
It only talks about changes you have to carry out in your computation of income, not in your books of accounts.
Yes, not in the books of account. People tend to mix up that. See, there is still a notion that if it is not there in the books, then the taxman will object. I don't think now that is there.
Correct.
Unfortunately, most of the people do the audit basically with a view to do the tax computation and all that.
Right. So
Zubin bhai, let me tell you one more thing, that a lot of people are in fact using income tax methodology as well as income tax rate for books of accounts. And when they are doing the audit, they are not even qualifying their reports that it is not as per accounting standard 6.
No, there are companies which have given balance sheets. I don't know this year, but last year or year before last, listed companies where the balance sheet is given under Indian GAAP and the audit report is given under Ind-AS. It starts with share capital and all that. And all that. At least you may give Indian GAAP numbers, but in the Ind-AS format, you may not do the Ind-AS adjustments. I mean, all sorts of things are happening. Unfortunately, these are relatively smaller companies, I think that way. So probably they are not much in the public glare. But if NFRA or QRB or somebody starts digging deeper into these cases, then companies sometimes in the future can get into serious trouble sometimes, especially listed entities. Also, many people are taking a lot of shortcuts and not taking things seriously. So there, you never know when a Pandora's box may open. Just now, the NFRA is concentrating only on the big four and the ILFSs and all those things. But you never know, because now QRB reviews are now stopped. I think NFRA will only take over all those reviews. Just now they are after the big fish. Tomorrow we don't know. So then there may be trouble.
Thank you, sir. Fantastic presentation and a wake-up call, I would say, for most of us.
Yes, it has to be. I think everybody of us needs to wake up. I think that. the big four have been shaken up, but I think you need to just first wake up. After that only you should be ready to get shaken up, if at all.
Right, sir.
Or probably the small fish, they are not bothered. So then I think we may all be lucky.
I do believe that there are smaller firms that need better support and better awareness.
Yes, absolutely. Oh, thank you very much. This is something unique. The first time I have seen on any online platform.
Okay.
So this we have
Thank you,
this
sir.
we have devised because we cannot meet physically.
Yes,
So
yes.
a certificate of appreciation for all our respected speakers, learned
Yes,
speakers
yes.
who have.
And thank you, Hinesh Bhai, for being
No, I
there.
am particularly thankful to Hinesh Bhai for recommending my name. I think, and I am very grateful and thankful to you, and nice to see you, Hinesh Bhai.
Yeah. Right.
Yes, yes.
And one of the authority on this subject, how can we miss you?
Right, sir.
Hinesh bhai, your voice is not clear.
Okay, can you hear me better?
Yeah, it's perfect. It's perfect now.
Zubin Bhai is a very, very dear friend. He has never said no for any program, any seminar, any lecture meeting of chamber. And very happy to share anything and everything what he has. That's the
Yes.
basic culture of Zubin Bhai. And
Yeah.
always say yes. If you tell him for a lecture, if he has no prior engagement, immediately he will say yes. Unlike senior speaker like him, who take so much time and we have to convince and then they say yes. But Zubin is just forthright. Immediately, absolutely no hang-ups and no formality. Thank you,
Yes.
Zubin Bhai, for always being with us.
Thank you. Thank you. My pleasure. My pleasure. Thank you. Thank you, everybody.
Yeah.
Thank you very much. God bless all of you and hope we are able to physically meet soon now.
Yes, yes. Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir, for sparing your valuable time for us, sir,
Yes, yes.
and
Thank you,
enlightening us.
everybody. Thank you. Bye-bye.
So regarding the next session, I think we have one more session left on the GD.
Yeah, but it has already been announced that
Yes,
tomorrow there will not.
we have already announced that due to certain unavoidable circumstances, we are not able to hold it on the announced earlier scheduled time. So the same has been rescheduled, and we will be confirming the same as and when we have the confirmation from the speaker.
And to add to that, it will definitely be after Diwali only, and not prior
Correct.
to Diwali.
It's going to be in the week following Diwali, that is 17th to 20th. We are expecting a confirmation from both the speakers. There are Mr. Vaitheswaran and Mr. V.S. Sudhir have confirmed their participation. We are expecting confirmations from them.
Okay. Thank you.
Thank you, sir.
Thank you very much, and have
Thank you, sir.
good weekend and happy Diwali to all of
Happy Diwali to everybody.
Yeah,
Happy
happy
Diwali, sir.
Diwali, sir.
Thank you.
Thank you, Hinesh Bhai.